All right, I'm live. Hey everyone, Douglas here, and welcome back to the MMT Macro Trader. We are live. I've got Bijou on the line as well. I was having trouble with my software right as I was hitting live. Didn't even kind of realize that I was jumping to the live screen. But either way, we're live. Welcome. If you're in the chat, say hi. Click the like button. Let me know you're here. And yeah, drop any questions, all that good stuff. Like, subscribe. And yeah, we got a good one tonight. Obviously, big news in the headlines right now is the debt ceiling market pushing quite lower today as well. And we'll talk about that, bringing up the market here. Yeah, that's where I'm going to start. So again, if you are here, welcome. If you're watching this after the live stream, hit subscribe. Yeah. Hey, WWB fan, welcome aboard. Yeah, hit subscribe, hit the like button, all that good stuff. Out of the gate here, again, I'm going to talk markets real quick. Kind of give a thought on what is going on for the lineup tonight. We'll be talking debt ceiling, obviously, kind of the biggie. Kind of the big event happening right now. And then we also have a couple other things queued up. Possibly talk Phillips curve. We can also possibly talk Eurozone. We got a handful of other things that we have on the dock ready to go. But if you have any questions, tonight would be a great night to send them our way. As always, we'd be happy to change course and discuss whatever's on your mind as well. But again, I'm going to start off with a quick market recap, and we'll go from there. We saw quite the selling today, and I think the S&P was down over 1.5%. It could be due to the debt ceiling issues. Eventually, if the debt ceiling stuff...
Time spent on that curve?
Go ahead. I'm sorry, Bijou.
Yeah.
Your audio feed was off. What was your question? You're back on, though. I apologize.
Oh, okay.
No, it was on my end. I noticed.
What's a day on that curve?
A day on
time axis?
On the chart that I'm showing right now? I think Bijou and I are having some communication issues. Anyway, market stuff. Apologize about that. Let's see. Oh, thanks for the likes too. They're rolling in already. Market's down. I'll tell you what. I think you could have the debt ceiling start to put pressure on the market as soon as I don't think we'll talk debt ceiling in just a minute here. But if it looks like the debt ceiling issue is going to, yeah, good question, Jesus. We'll get to that in just a second as well. If it looks like that the debt ceiling issue is going to become an issue, right? Then you will start to get hedging activity that becomes a bit of kind of a reinforced cycle, right? And it's what happens is big market makers, that sort of thing, will hedge. And what I mean by that is they're just going to open up option positions. Okay, it does look like we're having audio issues, so bear with me while I talk. Also going to try and fix the audio issues while we do this live. I apologize about this. Something clearly broke when we went live. Let's see, Bijou, you're gonna end up hearing me on the YouTube stream. I'm gonna get out of our meet, and I will be right back. Anyway, back to the debt ceiling thing. So what will end up happening is you will get large institutions starting to hedge. And what'll happen is that'll kind of create a reinforced selling scenario. They're going to open up option puts that forces dealers on the other side of those puts to hedge by selling shares into that, and they'll sell shares into that situation, and then that will just create downward pressure on the market, which will create more option buying, which will continue to press prices lower, and the cycle continues. And that'll start before the actual effects of the debt ceiling actually take place. So that is a problem. Bijou, it looks like audio is back up. So, all right, good. All right. Bijou is back on board. I apologize about that, guys. It's kind of just part of the the live stream process. So we can start seeing the negative effects from any potential debt ceiling issues baked into the market ahead of time if the market thinks, even gets the suspicion that they need to kind of overhedge for this situation more than any kind of normal overhedging takes place. So that could be part of the reason we saw selling, but I also think part of the reason we saw selling today is we are in the OPEX window right now. VIX OPEX took place today. So whenever there is the two main drivers of what I'll just call the noise, that's just the intraday back and forth sloshing that you see in markets. Essentially, let's just say if you place a 20-day moving average or a month moving average on a chart, 50-day moving average on the chart, if that's just the long-term trend, any bouncing around that moving average that you see in a day-to-day average or from day to day, that's kind of the noise, and a lot of that noise is derived from the hedging activity that takes place, and then that hedging activity has its own cyclical nature to it that revolves around these options being open and closed throughout any given month. And then there's two aspects of it. The largest aspect is the S&P itself and the hedging that takes place in S&P futures, SPY, and individual S&P shares. And then there's also the volatility component. The volatility options expire today. So there's always this kind of window of opportunity, this reset that occurs into OPEX. Now, the biggie is going to happen on Friday, but I also think you can explain some of today's selling by some of the repositioning that we saw as VIX options expire and kind of the lead up that's going to happen into OPEX. So whether or not it's debt ceiling stuff or not remains to be seen. But with that being said, the debt ceiling issue is going to become not only a pressing issue from kind of a market speculative standpoint, but also from the standpoint of the debt ceiling being an issue if it does not get extended and the Fed has to take, I guess actually my understanding is extraordinary measures already are being taken. And eventually those channels will dry up and then reality will set in. We'll have to see what takes place. So that's kind of my market update for now. Actually, no, I have one more thing. I actually think that if you're subscriber to the Patreon page, make sure you check this out. If you're on the premium tier, the trader tier, because I did go into extensive detail on quite a lot of bullish things that we're seeing play out here. But one of the components here that I want to take a look at. Hopefully this pulls up correctly as we switch screens. Really good progress being made. So this is essentially the national debt acceleration, in real terms, right? Adjusted for inflation. And this is so this gets printed at the end of every month. So this is at the end of December. In the actual models we build, we take this from the daily treasury statement, but this is pretty much close enough to what the models are. And as you can see in the blue line here, that's going to be the acceleration, right? This is kind of the input for what it is that kind of, at least in my MMT theory, is one of the major factors, one of the major determining factors for price. We're finally seeing positive acceleration again in this kind of acceleration feature, we'll call it, that definitely seems to give a 60-year month kind of heads up as to where price is going. So not only are we seeing finally an acceleration really take off in government spending, we're also seeing inflation as measured by CPI settle down. We're also starting to see, And again, check out the macro update that I posted Monday night on this. We're also starting to see the first signs of the credit cycle really start to roll over. So there is a lot of reason to believe that we could be heading into kind of the next big bull market. A lot of the things that we wanted to see are starting to play out. I think I haven't even shared this with Bijou yet either. I think there might even be signs that we could be maybe 6 months out from inflation ticking up once again. I think last week or 2 weeks ago, I shared the data that I collect from employment taxes, and there was a big jump when I recalculated it for Monday's macro update. So we could be 6 months out from inflation pushing again, which is everything I think you would expect from an MMT standpoint. And I say that with a bit of a chuckle because it's almost, I don't want to say too good to be true, but it's scary how well some of this stuff tracks. And again, this is like one data point, 1 week on a relatively noisy chart, but it's pointing that way. So it wouldn't surprise me at all. I think the big takeaway that I'll have, and then we can get into kind of the fun macro discussion, but it wouldn't surprise me at all if come summertime, if all of a sudden we start seeing oil take off, if we start seeing the economy getting hot again, that we have really a growth burst of inflation through the summer. I mean, I think the odds are increasing for something like that playing out. At this point, I follow my models. I'm not overextended. I'm not over leveraged. Back to very small bullish position, which I haven't pulled the numbers for tonight. Could be closed as early as tomorrow based on where volatility is. But we're tiptoeing closer and closer to really what could turn out to be kind of, I think, what you'd expect given the circumstance of where we're at. I think in terms of just the massive rate of change move that we're seeing in government spending, the fact that the income channel from the interest payments is only increasing, and the fact that, again, from that kind of MMT perspective, the higher interest rates themselves are inflationary. It's all kind of adding up, and I mean, we'll see how things play out in weeks to come. But it's definitely some fascinating data that is dropping. Big thing is, again, for at least the market watchers that are here, we are seeing the acceleration model that we have here really take off, and seems to be a good leading indicator of where market returns are going to be headed. And then the follow through on that is, or the knock on effect of all that is everything that comes with market growth going forward. So that's my brief market update out of the gate. I'm getting a lot of people showing up right out of the gate here. So welcome. Say hi. You're not short. I got big position on Friday night SPXU. Is SPXU, that's the 3x leveraged up, right? The U is up. No, I am not short this market right now. I am long, but not terribly long. Just for the record, this is my baby step, first step, toes in the shallow end sort of position. This is still very much a market that is very brittle, and it wouldn't surprise me at all if things get a little dicey. Anyway, that's kind of the market recap. We have people rolling in, so I like these. I like these updates or these live streams to be more focused on kind of broader MMT. Okay. SPXU is the short SPXU. I thought is SPX S then the long? Let me look this up. We're gonna change course here though, and kind of hit on the first topic of the night, Bob Knight. I'll come back to that point in just a second. Bijou, do you have any thoughts? I'm gonna switch over to your screen.
Yeah. Well, thanks for that recap and update. I think to me, it sounds like you're brittle is a good adjective to describe it, because it is a confusing period. Everything is not really back to normal, and so as a lot of CPI inflation and oil prices adjust, I think some of the policy responses are going to be a bit put one way, going one way or the other way, like push and pull, because if there's no real understanding of what really needs to be done, it could be a lot of to and fro, competing forces. And yeah, it is. At the moment, I'd be worried more about the debt ceiling for its psychological impact of all that.
Yeah, I think you're right.
And whether it actually turns into a really really tight austerity stance, I think is just really hard to know.
Mm-hmm.
Is the USA, are they trying to actually deliberately become the EU?
Maybe, yeah.
But then on the other hand, you just think institutionally, USA can't really do that, and it just seems to me like the psychology is still different. Americans haven't quite turned into Europeans yet, and the Europeans have such a different set of problems with their banking systems and that with the member nation. They're basically now, since the suspension of the Stability and Growth Pact and the emergency measures, from my reading of that, I mean, I'm not an expert on your EU or the EMU, but it looks like, now they've got many central banks. So the member nation central banks apparently are now buying a lot of the government debt. So they're acting as the government, a branch of the government, and the ECB is just supporting it all. And but to me, it's like they're deficit constrained, whereas the Americans have got this sort of fictional debt ceiling, which seems to always get pushed through one way or another.
Yep.
And it's just how resolute are the GOP going to be? How and is Congress and is the Treasury and Fed going to just find a way around it to inject the demand that's needed? It's just so many open questions, and it's so fascinating. The only sure thing is your accelerators are showing the story.
Yeah. I mean,
driving the story is all this policy.
Yeah. This is always the big. So look, you guys don't know this because we don't go live every single night, but Bijou and I talk this through every single night. And I mean, we're getting pretty darn close to finally hitting. Every time we go to hit play on the big learning model, I mean, I think we're pretty close to the features we want. We definitely know at this point, I think, the outputs that we want, and it's kind of now just down to finally classifying every feature, finally getting every feature nailed down, and then getting the parameters. But the big thing that will never be able to be learned in a learning model, in a deep learning model that we finally want to get done to prove MMT or whatever. Obviously, we're not. You guys get what I'm saying.
It's a special type of proof of MMT.
Yeah,
you can read that on my blog. It's one for the nerds.
Yes. Actually, speaking of blogs, Bijou, if you want to drop the link to your blog in chat, if you feel all right doing that. If anyone wants to read those. The other thing too is we did start posting some blog posts that Bijou is writing as well on the Patreon feed. So he added some. If they're pretty much the idea is for that kind of $10 supporter one is to just go into detail in anything that we start talking about in detail, and then do kind of more an elaborate, extensive blog style post on that and pretty much anything else. So just to plug the Patreon real quick, if you haven't checked that out and you just want to support us, you can check that out. There's a tier for that, and we did post one of the new blog posts there on the discussion we had probably about a month ago on accelerators and repellers and kind of that entire discussion. But go ahead and go on about the blog post if you were going to say anything. Sorry to cut you off there.
Oh no, there's a lot. There's a few things to say, but I'll try to not get too scattered. What I wanted to do is continue that thought on the banks and plug some of Bill Mitchell's stuff and
absolutely.
Ray, but
absolutely.
What's the best segue for that? I don't know. I thought the central banking issues were pretty important because they're linked to government policy and to ultimately therefore to unemployment and employment. And so there's that whole issue of education about what the Phillips curve is. That has Bill Mitchell in it. So there's all those sort of that cloud of topics that I'd quite like to talk about.
Hit on tonight.
But before you do, you mentioned like we don't have really a direct way to model a lot of the forces because it's psychology.
Yes, that's what I was going to get to. Absolutely. Thank you for finishing the thought.
And you see, because here's a bit of the fun stuff. We're kind of into the fun half now, but the semi-fun second, third is like I'm thinking, Douglas. You get your AI, which can now determine human posture from their cell phone data, Wi-Fi data, and you determine the posture of Congress.
Ooh, I like it. Yeah, I like where you're going here.
There you go.
Yeah,
we could do a neural network.
Yeah. Oh my God. Listen, there's some mental postures that I really don't want to determine. Yeah, I mean that's the tricky part, right? We don't, it's really kind of a game of chicken. Ultimately, who's going to win out is the pot. I mean, wherever the money is, that's what's going to win out.
Exactly. So that's what we're talking about.
Yeah, and that's also the impossible thing to. The psychology part's impossible to predict, right? I mean we can track the flows, we can track all that. But it's a game of chicken, and do the Republicans, do the GOP want to keep their foot on the gas and keep going straight and not fall off here.
Okay, so here's the thing that we were talking about. You remember?
So,
and this connects back to Randy Ray. So I asked him, what's the best thing that MMT activists can do, and it's like, well, forget a little bit about the politicians because they're not leaders, they're followers.
Yep.
And you've got to change broad public sentiment. And so MMT education project is long term, and it's going to take a while, guys. But in the meantime, we sort of have these very weird allies because so we've got this probable debt ceiling psychology crisis. It's not a financial fiscal crisis yet, but it's a psychology problem that's going to perturb the markets. Now, think back to when any other government had stopped issuing bonds, and I'll go back to Australia. Now, the reasons might have been different. They weren't talking about debt ceilings. They were just talking about retiring government bonds, not issuing more bonds. Now, I think it was Tony Abbott and Peter Costello were the leaders at the time. I think they're the Australian Conservatives. I don't know. I don't really follow the people over there too much, but this was way back, right? Abbott and Costello. Could you write the script of that? Anyway, what happened? Well, then the Sydney, Canberra, wherever the bankers over there cried to the government in Canberra, give us back the bonds.
Yep.
We need these bonds. That's our basic income scheme for the rich. So, or as Warren would say, for people who already have money, which is a more polite way of saying it. So I think Wall Street, I mean, if they don't issue debt in America, Wall Street are going to force them to, because they're the ones that hold the power. They're the de facto leaders of your country. You've got to admit this. Wall Street, Silicon Valley, some of the oil oligarchs in that. They push Congress around as if Congress are a bit like rag dolls. And every so often, people in Congress get some balls and they do something a little bit more progressive. And so I think Wall Street's going to crack through the debt ceiling for you guys. It's just a matter of. I don't have a crystal ball on any of this. I'm just going by past history of what happened in Australia and what would probably happen in any country. The question is though, what the sort of fight is going to be between Wall Street and the GOP, and a lot of weird stuff could happen. So like you say, it's brittle. It's just very interesting.
Yeah. So going back to your point about being short, Bob Knight, you could absolutely be right, and I could be wrong. It really just depends on. I mean, in one part, what's your time horizon for any given trade, and then and then what factors are you trading on, right? In one sense, we could both turn out right. Through the remainder of the week, we could see some selling, and then next week, we start an uptrend. So
let me just close my door here.
Yeah, Josh, absolutely, the donor class, and that'll be it, right? And we'll get into more detail on this as the night goes on. But at the end of the day, the banking system is very reliant on the issuance of these bonds, because they built their kind of banking superstructure on top of these bonds. These bonds act as collateral in the banking system, and it's the overnight lending that takes place. A lot of the back and forth takes place because of the bills that are being issued. So that is, that's one aspect that, I mean, as we'll see tonight, it's a stupid system. I mean, it's just it's a system that's unnecessary. That is just I mean, if you followed any MMT discussion, I mean, it's set up for politicians to be able to get some free airtime every year to 18 months. But nevertheless, it's a system we have, right? And it's kind of tragic that we have it. Maybe one of the things we could talk about is the mint coin, the platinum coin, to kind of once and for all put an end to this, which is
okay.
Which, I mean, it should just be a political decision to finally change the way spending happens. But I think you're right. I mean, ultimately, it's going to be Wall Street that comes to the Republicans and are like, hey, look, the reason we donate to you is because we get free money and we need that, we need that gravy train to keep happening. And if it doesn't, there's no money to donate to you.
So, Wall Street is doing mint to coin their own way through treasury bonds. So I don't see the Democrats minting the coin ever, at least not in our lifetimes, because they're controlled by Wall Street and the big bankers and oil. So and the idea of mint to coin, I think, is a good one, and it's sort of political theater. And you got to realize, it probably wouldn't work in New Zealand because we're a bit more like cynical or just down to earth. We don't like political theater and stuff like that. But if you're in a country where political theater is a really big thing, drives advertising on the news networks and debate on YouTube and all this sort of stuff, then mint to coin becomes a kind of a good idea, because you can you can go through the whole performance of it. Someone coming down to from Treasury down to the Fed and dropping this coin and all the cameras and everything.
Yes.
And there's a case to be made that theater could be very effective as an educational thing, but it doesn't do anything to help the plight of unemployed workers or anything like that. It just allows the government to spend on whatever. It still needs Congress to appropriate the funds for more productive investment and employ people doing good things rather than fighting wars. So it solves only half the problem in your politics. Just gets rid of the whole deficit thing, which we thought that COVID had done that already.
It's pretty wild. It's pretty wild
where you get
it's pretty wild.
Where you get the injections from. But maybe it hasn't solved. Maybe we haven't quite turned that corner yet, and so mint the coin becomes a good strategy for getting that half of the political economy sorted.
It's still, this is going to be, I've in my notes for future tweets when I get back to Twitter here. One of them is just laying out the fact, and I think, let's see, it's if you're 35 today. So I mean, let's put it this way. I was 16 in 2000, I think. 16 in 2000. So that means the great financial crisis, I would have been 24, and now I'm 38. Okay. So that means I don't know how many leaders are younger than me that are in Washington right now, but my guess would be 85% of the leaders that are in Washington have lived through and have vivid memory of the 90s, the dot-com bubble, the great financial crisis, and then COVID, right? So we've had in the lifetime of the vast majority of the leaders that would be in Washington right now, they've all lived through, and it is still very much recent memory, 2 times where we've been in a budget surplus situation, and then 1 time where we could have been in a massive budget surplus situation, but decided to enter deficit spending. And the outcomes were completely different. I mean, we had 2 horrendous outcomes. that wiped away not only the wealth of millions, but also just the opportunity, not only in the U.S. but Europe and the rest of the world. I mean, we've done the austerity game, and I mean, if you're listening to anyone that is saying that the government needs to finally get their spending in order, and you're taking any advice from that person, any financial advice, run for the hills. I mean, run for that. I mean, I'm sure if you've made it this far to the live stream, it's not you. But if for some reason it is, watch what we're saying here. Look at the data on the screen.
Right.
It does not work the way you think it works. It works the opposite way. Yeah.
We're not going to do a clinical tutorial on this in a live stream, but if you're a skeptic and you're anti-MMT coming here, try to bear with us. I'm telling you guys. So what we've had is a double whammy, right, Douglas? Not only has it been fiscal austerity, so score points on people's bank accounts are needlessly low, in fact negative sometimes. How do you get a positive score in your bank account? Someone else has to go negative according to all the accounting rules that are pretty much obeyed. And if you want the economy as a whole to do well, if your real production can support sales, then someone has to go negative, and that's the government. Yep. That's actually their role. So that's score points. That's only score points. But you look at recent history, people, the GOP rhetoric, even the Democrats are like, oh, we're living beyond our means. Okay, what does that mean? It means the government is in negative position on its balance sheet, and the rest of the economy is in positive position. That has nothing to do with living beyond your means, because governments can always service that debt, or they could just issue the currency and forget about the bonds and set the interest rate to zero. So it's no longer kind of seen as servicing a debt. It's just outstanding cash and notes and bank deposits become the private sector's funds with which they could pay the tax liabilities. But you see, the double whammy is that throughout this whole era, real production, real resources that haven't been employed, that could have been employed, no problem, without draining energy, real resources going into real production have not been employed. So there's been this era of just lost real output.
Yep.
And because you're in a monetary economy, that's all a function of the score points on firms and households, bank accounts being a bit too negative.
Yep.
They have to take out credit in order to create that growth, and then that has to be paid back, and you get that Minsky type of dynamic. So,
which, just to riff off that, kind of thinking out loud here too. One of the things that's always kind of bothered me is people talking about how the zero interest rate policy is really what caused the generation of all the zero revenue companies, zero net revenue companies that were created from 2009 until they're all kind of blowing up now, right? These companies that get $50 billion valuations, electric scooter companies that become larger than car companies. Nonsense, right? I mean, it's all nonsense. And really, my thought on this, and I haven't thought this through, but we can kind of think it through live in real time. But I really think that is more a symptom of a government that isn't pushing rates to zero, but instead a government that isn't focused on full employment for the economy to achieve max output. And the reason that things like Beyond Meat get billion-dollar valuations is because it's up to essentially the financial markets to determine the winners and the losers. And what do the financial markets want? They want asset appreciation. They don't care they don't necessarily care. Obviously, part of a valuation of a company will be, what it is they output. But they do care about asset prices going up. Right. And so that is how the winners and losers are chosen. I don't think it had to do so much with the low interest rates that a lot of these nonsense companies, have now come and went. I think it has much more to do with the fact that the government has been out of the game of what it should be in, which is promoting full employment and full output of the nation, versus just kind of kicking the can down the road, constantly saying we can't do that. Anyway, thinking out loud.
Thinking out loud on that same issue, right? So the way I think about that is that private banks operate on the spread. So if the floor rate from the Fed is zero, the banks will charge a rate above that. If the Fed rate is 25%, then the banks will charge 27 or whatever, a spread above that, and so it just distorts forward prices and so forth, and is a massive gain for the rich and a massive crush to people in debt, who need to go into debt, who are forced to because they aren't getting enough wages. But the basic idea is that, how do you get a loan? It's not because the interest rate is zero. It's because you either need the money, you want the money, you want to expand, and the bank is going to charge you a little bit above the floor rate for that.
Yep.
And how? But then still, how do you get a loan? You don't just whip out your credit card if you want a really big loan to start one of these companies. You have to inflate your expected earnings and your expected sales. You have to do some sort of, presentations to your bank managers to just show them, you've got wildly optimistic future ahead, and then the banks will be prepared to give you the credit, to give you the loans. And so it's about that side of the banking, about credit worthiness, about credit risk, and just wildly inflating the numbers. And the way it's designed at the moment, I'm not sure really, but I can buy the argument that the banks really don't care too much about credit risk, because they're just looking for an excuse to legally issue loans, or illegally, if they can get away with it, to get people into debt. Because no matter what the firm does, if it collapses later, they're just going to seize all the assets and so forth.
Yep.
So it's a pretty corrupt system, even when it's operating legally. And just the discipline on lending has to be on credit worthiness side, the credit assessment side, and that has to be just much more better regulated and tightened.
Yeah. And
the interest rate is then almost irrelevant, right? Almost irrelevant, as long as it's reasonable. So, I'm not saying that Islamic finance, where you've got zero interest rate by ethical design, is good or better. I can see a good case to have a positive inflation rate. You want some moderate inflation, I think, to make money a little bit hot, and to so that people with savings are always thinking, my savings are inflating away a little bit. I don't know the language for that. They're losing,
depreciating.
All they do is hoard.
Yeah, exactly.
So they got to invest. They want to invest, and that helps other people, right? So yeah, I think look, just focusing on zero interest rates is just really not the discipline. Having high rates is not the discipline, I think, that is really needed. But yeah.
Yep. Yeah.
While we're doing that, I could maybe just mention Bill Mitchell's talk, because I think just before we go to some of the questions, let me just share the other screen. I'll do Randall Ray thing a bit later if it comes up. Okay.
Yeah.
But
share your screen and give me 1 second to make sure when I switch over that
all right,
that it's correctly aligned.
So I was going to talk about some recent Bill Mitchell discussions, and then maybe a Phillips curve as well, if people are interested. But if it gets a bit boring, let us know. So just tell me to shut up. I'll gladly go back to questions, but just while it's sort of fresh in my mind.
Yeah, right on.
Oh, there you go. We're up there.
Yeah, we're up.
Good.
Yep.
Okay.
Yep.
So let me have a look. Scroll through this. First thing to maybe just highlight there is this Majority Report episode. If you're interested, Sam Cedar. Not everyone likes him, but there's an interesting take on the FTX debacle. And if you want to read the YouTube comments, you'll see me weighing in there, but as long as they haven't deleted it. But yeah, it's interesting because they get some of it right, some of it wrong. And the co-host, Emma Vigeland, is a good moment where she just laughs out loud when they mention that the stable coin and the other cryptocurrencies that are tethered to the US dollar, because she instantly gets it. She's not economically literate, but she instantly gets it, that all it is just a payments layer, and they're just
Yeah.
that's how Bitcoin could have worked if it was not a currency but just a private payment system, and then it would have helped the black market and people who want to stay under the radar, and would have been all good for them. That's the way they could have done it if they were smart. And Douglas and I were talking about really how smart was that guy Blankmanship or whatever his name was.
Bankman-Fried.
Bankman-Fried. Yeah. Bankman-Fried now. Bankman-Fried tomatoes. So yeah, that's an interesting discussion. If you want to, I can maybe put that in the chat later. But I want to get on to Bill Mitchell. So first of all, I'll just copy you his talk here. This is a talk with a Japanese economist at Bill Mitchell's. He's doing a sort of sabbatical or collaboration with over there in Kyoto. And the only thing about this one is that I put it in the chat, but it's mandatory to listen to it. The speed limit is 2 times speed, right? Yeah, that's the lowest. You can't go lower.
Yeah.
No, probably 1.5 times speed is good, because Bill talks slow enough already. So if you don't want to send yourself to sleep, stick it on double play, and instead of being 2 hours, it'll be 1.5 hours or whatever. But the reason I mention it is a pretty good discussion, because he talks about some things that we've just touched upon related to debt ceilings and that. So in Japan, they have it a little bit differently, right? So they have this sales tax, and they seem to be using the sales tax as their sort of tool to thump people over the head with. So it's like Japanese productivity is going down, and we've got increasing old age population, but not an increasing youth population at the same rate, and so there's a dependency ratio issue there. This dependency ratio in Japan is a problem for them, their retirees. So it means they have to do a lot of automation to stay producing the things that their retirees want to consume. But the sales tax is the tool that this Japanese economist Satoshi, he talks with Bill about, and it's like every 15 minutes he brings back the sales tax. But it's interesting because he bombards Bill with this data during the talk, and it's quite fresh, because you would never see Paul Krugman or Summers or the other guys. I forget all their names. They would never submit to just a live stream where someone that has a computer in front of them and could just pull up any data and like argue with them about it.
Yeah.
This is what happens, and Bill is quite composed and he deals with it really well. But I mean, both of them agree. Right? Every time you got a sales tax, every time there's a sales tax increase in Japan, what happens to the chart is that the government deficit will just go up. So the sales tax is here, and then they make the sales tax go up. And what happens to the government deficit? I don't know. It's doing something here, and then it goes up. So what's happening there is, instead of the sales tax being revenue for the government, it's actually forcing people into debt. It's triggering the automatic stabilizers, welfare, and so forth, and it's triggering unemployment, and it's causing a kind of a recessionary impact, which Japanese people deal with in a slightly different way to maybe Americans or Australians. But you have to deal with it some way, and the way it happens is the government deficit actually increases, which is the opposite to what they want to do, right? So what the government was thinking.
Oh, that's interesting. Okay,
yeah. They want to reduce the government deficit, so they think it's going to be like this, right? It's in their heads of the central bankers.
Yeah.
Mr. Central Banker. Do they have bow ties? Probably bow ties. So, but it goes the opposite way. So it's like if you're trying to, what's a good analogy? You're trying to push on a rubber band or pull a spring, and it just springs back the other way.
Yeah, that's interesting. Yeah, yeah,
Pushing on a balloon or
yeah,
something, you're trying to squeeze the
yeah,
balloon, shrink the balloon, but it's just going to pop out in some other direction. But the interesting thing is that they've got this. The guy talks about this lost decade, and Bill pushes back a little bit on this. He says, well, you sort of, relative to other countries, Japan didn't do so badly in terms of per capita GDP.
yeah,
And so that's a little interesting discussion you might want to look at. The Japanese weren't doing too badly, but they were only doing as good as any other neoliberal nation could, because they still had these artificial constraints. And then there's discussion of the dependency ratio, and but then also the interesting contrast between the Japan Central Bank and the other central banks is also a really good discussion there. And it's interesting because Bill kind of floats the idea that, perhaps even though the political rhetoric isn't really there yet, a lot of central banks have learned the lesson that they can always avoid a purely financial crisis. Okay, so the banks can't do anything to avoid a COVID pandemic or a crisis in the real economy. All they can do is ameliorate that. And they haven't really learned how to do that, right? They haven't learned that the way to do it is to give money to people at the base of the economy, not at the top end. That's the lesson they haven't learned yet, which I'll talk about in a minute with the Phillips curve. But you sort of get the feeling that Bill, if there's no climate crisis or environmental crisis or anything, or more severe pandemics, then the central banks kind of have learned. So if there's a Minsky exuberance or upwards instability again, it probably will happen because they don't really have the ideology to stop that from happening. But when there is a crisis and there's a massive debt pay down in some sector of the economy, I don't know what it will be. I mean, it might be real estate again or whatever. It's hard to say. Then the central banks seem to have learned just by stumbling into it, right? They've sort of learned MMT by default. They still don't want to call it MMT. They probably still don't believe MMT, but they've sort of stumbled in that position.
Yeah, that's one thing. I mean, that's one thing we've. Oh, sorry. Keep going.
Yeah. Oh, you can come in a minute. I'll just finish the thought because it's interesting that I was also reading Bill Mitchell's blog, and there he's got a couple of recent ones in January this year, I think, maybe December the last year. Anyway, they're recent, talking about the Eurozone and how it's interesting because he's very negative about it. He thinks they really haven't learned the lesson and all. And once the emergency, quote unquote, emergency measures are relaxed, his thinking is they're just going to go back to austerity, and that's going to cause more crises in Greece and Spain and Italy, and then it's like it's a yo-yo thing or whack-a-mole or something.
Yeah,
it's going to maybe take longer, and so I shared a link to a conference discussion, the European MMT conference with Douglas, where Warren is much more optimistic. He reckons that this is just my reading. I'm not quoting Warren, but my feeling was that Warren thinks that the European central bankers have sort of learned the lesson and will do whatever it takes if there's a sovereign or member nation debt crisis in the future. The ECB will just buy the debt and just operate it. It's a charade. It's a game at that point, at that sort of level that unfortunately impacts the poor, but in a terrible way. But at the higher level, this game that these policymakers and central bankers are playing, at that point, it just turns out to be sort of shuffling numbers on spreadsheets, and so they'll buy the member nation debt, and the central banks will get paid their interest, which is just the left pocket paying the right pocket. And things will work out like that. Whereas Bill was a bit more pessimistic, but Bill Mitchell was saying that he thinks they're going to go back to austerity and reinforce the Stability and Growth Pact and constrain the deficits with all the penalties and everything. And then the member nation debts will spread, and then there'll be the markets. They'll be beholden to the markets for the bonds, and until there's another crisis, and then maybe the ECB will bail them out. And who knows? Maybe the next time there's a big debt crisis in Europe, and there's a nation that needs to be bailed out. Maybe that will be the time where they finally, go full Mosler. But so there's two competing views from two top MMTers, right? There's Europeans are in for a really bad time ahead, or maybe not. Maybe they'll just stumble along into a sort of a quasi MMT framework without the job guarantee. Some thoughts. What do you reckon?
I reckon EURO. I reckon that I just posted the link to the Warren Mosler European discussion since I was able to find it. I also reckon a handful of people just showing up here. Roa Nora, welcome back. Glad to see you here. Real progress in action. Just talked to Bill on macro and cheese, so I believe that would be Steve, right? Grumbine.
Yes,
Grumbine. So yeah, welcome. And Bijou told me to listen to that one as well, so it's in my queue. Check out his podcast if you haven't. Bill Mitchell's obviously a great thinker and a good communicator.
He's a good expert on Japan too.
Is he?
Good. Even to the point of learning their language.
Oh wow! Okay.
But he studies Japan because to him that's the biggest economy that is doing something vaguely MMT-ish.
Yeah.
The Japanese central bank is buying the government's debt, so left pocket paying right pocket.
Okay.
And that's led to decades of very low inflation. But instead of using the inflation as fiscal space to invest and spend, the Japanese government's still doing kind of austerity. So they still have a little bit of unemployment.
Yep.
But the cultural thing that Bill talks about is that Japanese hate unemployment like more than anyone else.
Okay.
They don't like to use Nairu, the non-accelerating rate of unemployment, non-accelerating inflation rate of unemployment. So that just means that there's an unemployment level, fictional unemployment level, say 6%, where inflation will not accelerate.
Mm-hmm.
And you might get constant inflation. So every year prices go up by 2 or 3%, but it won't accelerate beyond that. So the price level goes up over time, as it probably should for any decent economic system that's fiat currency based, but it doesn't accelerate beyond that.
Yeah.
So that's the Nairu.
Yeah.
And so I think the Japanese culturally don't want to believe in that, but their bankers kind of, I don't know, maybe they do, maybe they don't, but culturally they are far more averse to people being out of work. And so they've sort of stumbled and struggled along into quasi MMT positions, like I said, without acknowledging MMT, without even thinking that it is. It's just like, if you want to, if you aren't just totally evil,
yeah,
and you're running a system like this, your groupthink is going to morph over time into an MMT position without realizing it.
Yep. Yeah.
But in like Europe, it's far more severe, and in Congress, US Congress, it's far more severe. The groupthink is very stuck in monetarist, new Keynesian type style austerity stuff. And you need the unemployment to discipline the price level. Right? That's the whole thinking. That's totally backwards.
Yeah.
Totally backwards. How do you lower prices? Produce better output. So you employ more people. So instead of doing in Japan where you've got a lost decade and increasing sales tax because you think you need to reduce the government deficit, and it just it goes the opposite way to what you expect. So instead of saying, you lazy workers, get back to work, and if they're too lazy, we'll club them on the head again, and just brain damage them, discipline them. So that just makes them worse workers, right? So the idea is that, even Japan does this, right? Even though they don't want to culturally, but all the neoliberals are doing this. Like, you see, you lazy workers not working hard enough, get back to work. Okay, I'll cut off your, one of your fingers. And then it's like, you're still not working hard enough. Okay, no matter how many fingers I cut off these workers, they're still not working hard enough.
Yeah, exactly. Yeah, why does production keep going down? Why can't you get these? No
matter how much I cut off the stick, it still keeps getting shorter.
Yeah.
This is neoliberalism in a nutshell.
It was one of the things that culturally too that that Warren Mosler points out at the beginning of the discussion he had, the Europe MMT discussion, that I never really thought about, but I like instinctively knew because I've seen it and experienced it, and that is just that there really is a demand in the U.S. populace to have unemployed people, in part to exploit the lower end of the labor class, right? There's a demand to have people working thankless, low-paying service jobs. Yeah, we all know
it's sort of a warped Protestant type of ethic, isn't it?
Yeah, really.
Really,
Yeah,
really
yeah.
And you were talking about the boomers having that kind of...
Yeah. Well, I wasn't going to call out. I wasn't going to call it any. Yeah. But since you did,
really? I did. I'm okay going there.
Yeah. No. It didn't dawn on me until Warren said exactly what he said in the discussion panel that he had. But I mean, I've heard the sentiment that again, a certain person I have in mind who was complaining that she couldn't go to the local brewery burger joint on some Wednesday night because they weren't open Wednesday nights because they didn't have enough people to cook the burgers. And in my mind, I'm thinking that means that the kid that normally would have had to have worked that job is finding something more productive to do than make this person a burger. And it is just, I think Warren hits the nail on the head. There is a demand for the desire, the social desire is for cheap labor that can do those service jobs. And in order to get that, you need a policy of at least minimal unemployment, right?
Yeah, right.
If it's maximum...
They think so.
Yeah. If it's...
Make people desperate to eat.
Yes. And if it's if employment is maximized and output is maximized, the downside to that is you might need to make your own cheeseburger, like
make your own burger.
That
go
could
to the grocery
be
shop and get some fresh ingredients.
Or Ronora, as you're pointing out, it would push for automation of some of this stuff too.
Automation. Okay, I was going to close the loop on that.
Yeah, yes. Go for it. Yeah.
This is all converging, you see.
Yeah.
This is very mystical. Mystical convergence of the spheres. So look at the dependency ratio in Japan, which I've got there under Bill Mitchell, right? Is I wasn't as pessimistic. I mean, because the Japanese are fine with automation. They love their automation and robots and that. So I think if they keep going down that road, then they have ways of easing the dependency ratio problem. It might cause a bit of pain, but it doesn't have to. And that's automating the shit jobs, right? Not the bullshit jobs, the shit jobs that have to be done. And so, if you're not just saying, well, we've got to get our youth to do all that shit work, and then they can later on get the comfy positions like the boomers and retire and so forth, and just perpetuate that whole cycle. There's a way that we can break that with automation. And as far as I know, only MMT economists and activists understand automation, and that the Yang crowd are just completely nuts on that. They see automation as putting people out of work, and so you need a UBI, blah blah blah. But it's just they just got it totally backwards. Automation frees up human labor to do
even more productive stuff. Yep.
Playing e-games to entertain other people.
Yeah. Doing live streams on Wednesday night at 8 makes you show up every week.
Instead of having Torsten Veblen's leisure class being only the upper class, the leisure class can be everyone.
Yep.
But we've got to automate. So we've got to push the automation, not be Luddites and shrink it back. But only the MMT understands that it doesn't cost anyone's job to do that. You just give them better jobs to do.
Yeah.
Look after kids, do some teaching, do some crazy, YouTube educational stuff.
Yeah. Let's see.
But I was going to do Phillips curve and manifold. The Phillips curve is not a curve. It's a high dimensional manifold. I'll just put that up on the screen. But I think I'd prefer to go to questions.
We do have some questions.
Maybe they're building up.
We do have some questions. One other thing too, Roar Nora, you had a few questions up top. We are going to get to that a little later on. So remind me to scroll up when we get to the government spending topic a little bit later. We'll also obviously talk Phillips curve. One thing I wanted to point out too, it'll be in the back of my mind for a while, is the idea of learning their lesson, to do central bankers and everything learn their lesson. I do think the one thing that we can say for certain is that deep down, central banks understand what must be done, right? In other words, when shit really hits the fan, we now know that all central bankers understand that they can't push austerity. We didn't know that in 2008, right? I mean, in 2008, they let banks fail. They let two of the largest banks in the U.S. fail. So we've at least figured that stuff out. Now, in the meantime, do they fully believe it? That remains to be seen, right? I mean, I think that's the debate. I was giving Bijou the analogy of when I was in ninth grade, I played lacrosse, and throughout the entire season,
this is a good analogy.
The coach always made sure everyone got equal playing time, right? And so I played defense, and I think I probably was our best defender. I played defense, and we'd always go on whatever 60 seconds or 2 minutes, and then we'd go out however long the time was. And I knew my time was almost up. And we were in the playoffs, semifinals. If we lost, we'd go home. And I went to get off the field, and all of a sudden my coach is like, "Nope, Doug, you're staying on." I didn't understand what was going on. Well, I got it, right? This could be it, right? I mean, we're facing an existential crisis. If we lose this game, our season's over. The tournament's done. We all go home. That's kind of where that's kind of where the central banks are at when crisis hits, right? When the crisis hits, that's when they play their real hand. And at least we now know that their real hand is, nope, we're not going to impose austerity. What we're going to do is effectively MMT with with blinders on. Poorly
MMT, but
poorly
we knew this already.
Yeah,
it's nothing new.
Yeah,
go away. Nothing to see here, folks.
So that is the good news.
I think doing MMT.
Yeah, exactly. Yeah, this is just exactly what we had the entire time. This is exactly what Ben Bernanke wrote that you should do. And how to dodge a depression.
The Bernanke ball buster. That's one of our neural networks.
Oh. Yeah, write it down. So I at least wanted to kind of finish off that thought. And we can move on from at least I mean, we'll find out sooner or later, I'm sure, if central banks have learned their lesson or not. Hopefully they have, but
So definitely have a look at that link that Douglas sent on Warren's talk there. It's pretty interesting getting contrasting views. Is that the MMT conference or the Zurich talk?
It was the political economy of fiscal policy, Mosler, Truger,
the more recent.
MMT 21, economic policy, post-pandemic world. Talk. Yeah.
Because that has a bunch of Europeans that a little bit post-Keynesian-y. They don't really understand.
Yeah,
they're more pessimistic because they focus on politics and realize the crud in the system. And Warren's like probably more optimistic because he sees it's like they're up against the wall. There's no options. You just have to, if you don't want people dying on the street, you just have to open the spigots. even if it's interest income to the rich, you don't have a choice. You get backed into quote unquote doing MMT, even though that's not a thing. Doing fiscal rather than.
Which the fact that that's the choice they make when their backs are against the wall means that there's at least an understanding. And maybe it really was.
Understanding.
And maybe it really was just because maybe the dots they connected is, okay, we're going to have 50% unemployment for a few weeks. We have to give them income, right?
Yeah.
But I guess even I mean, in the warped world that is neoclassical economics, 50% unemployment should just make people work even harder, right?
Supposedly.
Right. So maybe
Take him
that's
over the head again. Cut off another worker's finger.
maybe that's
Make him work harder.
really why we saw such an amazing economic boom following the pandemic response, is because the 50% unemployment just made people realize how hard they really need to work, lest their job be taken from them.
Totally. They're all sick, and they realize, I'm going to go back to work.
Yeah.
I'm
going to switch over to the. Oh, go ahead. Sorry.
Yeah, switch over. Oh yeah, just another interesting bit of the recent MMT news. It's all very not current affairs, right? It's all very looking at a long view of things. But this again, I think was on Bill's blog. It's interesting because some stats came out showing that in Britain, a pandemic has led to retirees really leaving the workforce, and probably that's a function of the fact they didn't have as many protections there from Boris Johnson and that.
Okay.
And in Australia, it's sort of gone the opposite. The retired are getting back into the workforce.
Interesting.
So
okay.
Very opposite effects, and that's very cultural, national policy dependent. Australia did pretty decent lockdowns, I want to say, not as good as Singapore or New Zealand, but they certainly did pretty decent lockdowns, and suffered all the political backlash from that, from the crazies and the anti-vaxxers. But it did change their working
dynamic
professional class. They realized they could now work from home, and they're happy to go back into the workforce. It's maybe precarious jobs, so not very great, but still the opposite to Britain, which is kind of interesting.
That's interesting.
Anyway.
Yeah.
Hey, what do you want to do now?
Well, I've got the chat up. I don't know if you want to scroll up and if there are any questions that really caught your eye.
I'll have a look.
Otherwise, we can definitely get on to the Phillips manifold as opposed to the Phillips curve. As you do that, and before we get down to the Phillips curve discussion, one of the things that I'll admit here is in my learning of MMT and this is to set the stage for the Phillips manifold, Phillips curve discussion. I did have quite a few economic classes in college, but from when I graduated, so 2008 until I think about 2013, I would have been kind of in the Austrian school, and then figured out MMT. So there's a lot of the neoclassical economics that I just skipped over. One of those things is the Phillips curve. I have heard I've heard Steve Keen, I've heard the rest of them all explain why the Phillips curve is bunk. I've just never, since the people I trusted told me it was bunk, I never took the time to go figure out what the Phillips curve is. So when we get to the Phillips curve,
attitude.
Yeah. If it's not going to help me, what I'm trying to do, look, I'm trying to figure out what the hell makes market ticks. Or
what's this rule in this multiplayer online game? What's that rule? I forget it. I don't need to know, man.
Oh, come on, give me. Oh my God. I wish I had Hamel here to back me up.
Who needs the rule book?
Yeah. Phillips curve. So if you see any, I thought you were going to dog me for my gaming. Ty, welcome, by the way. I'm glad to know you've got us on the big screen with the wife watching. We'll keep it moderately clean. If you see any questions, Bijou, that you want to hit up right now before we jump into the Phillips manifold, let me know.
I'm going backwards a little bit.
Okay.
What I'd like to, Bob Knight's got some interesting personal comments about investment and credit scores and everything. I'm really interested in what these credit scores are. I'm never going to have the time to really look into it, but it just reminds me, Bob. I'm not sure this is related at all, but the whole credit rating industry. Oh man. It's like, what a tremendous waste of sort of human labor hours that whole industry is. I remember back in the 80s when New Zealand went neoliberal with a Labour government, we were really worried about our credit rating. Okay, so this was really related to whether the New Zealand government could pay its debt. And of course, if it was issued in New Zealand dollars, the credit rating was infinite. No one understood it.
Yeah.
But Moody's were telling us we were now AAA rated because we were doing austerity with the Labour government. It was insane. And we were going to privatize all this stuff, and, or at least state-owned enterprise type of privatizations, which we did. We went ahead with that. And then, like back in the late 90s and early 2000s, our government bought back a whole lot of these things that had been privatized because the private sector were ruining them. Trains and things, banks, public bank, post office. But yeah, credit ratings, man, credit scores. Yeah, trying to look at other questions. Josh has got some comments. Interesting. Well, he does have a question mark there. Is that similar to what venture capitalists who act like vultures on a company do? They don't care about their success of the business. Oh yeah, I think Josh, that was maybe picking up on a comment in the chat or that I made maybe about banks. They'll loan to anyone who they can semi-legally think is credit worthy and fill in the paperwork for, because as long as they've got a little bit of income and sales, that's all the bank needs, because they'll strip them of all their assets and when they go bankrupt. So the bank doesn't care about the firm going bankrupt. I mean, I'm being ultra cynical here. Obviously, there are ethical bankers; they do exist, and there are bankers who do deeply care about investing in good businesses. But systemically, there's all sorts of types of bankers, and the discipline the discipline doesn't have to be on the interest rate. It should be on credit worthiness.
Yep.
If you're going to discipline credit that way, and it doesn't hurt the economy to have a lot of discipline on bank credit if the government has a good fiscal policy and targets their investment, which doesn't incur any debt to any bank.
Yeah, exactly. I mean, that's it, right? We want we want a good mix of both. Yeah,
good mix of both capital for private investment credit and government investment in what the public generally wants, what achieves the public purpose. They're shutting down our local swimming pool here that used to be kind of free entry because our local government can't afford to keep the maintenance going.
Which is quite the problem in the middle of summer in New Zealand.
Yeah, it's great. It's still only $1.50 to get in the pool, so that's not too bad. I didn't see any
any other questions? Yeah,
some interesting comment.
Let's change gears then. I want to talk Phillips curve.
Okay, Ty. Yeah. So the original paper by Bill Phillips is good because if you read the original paper by Bill Phillips, oh geez, I should probably pull that up. But at least get the Google Scholar link to it. If you read the original paper, it was back in the 1950s or something. You'll see that he does talk as if it's a manifold, and he only. Sorry, I'll get the link later because a whole lot of other papers came up that weren't actually original. I'll get the original later. So Phillips talks about, he's a Kiwi, by the way, engineer. So you can blame us on the Phillips curve. But as Steve Keen points out, I also read, Steve Keen has a good talks about the Phillips curve. In a lot of his lectures, he might mention it. He almost guaranteed to in one of Steve's lectures. And I think in the original paper, Phillips mentions a couple of factors influencing the price level. So there's unemployment, the rate of change of unemployment, and the interest rate. But if you think about it deeply, there's probably many others. So that's at least already a 3 or 4 dimensional manifold. And so it's not a curve in that case. So let me have a go at drawing this. Let's see how it goes. This is live cartooning, guys and girls. So I had just a short list of things that weren't mentioned in Phillips's paper, and I'll get into a minute why they're not mentioned, perhaps. So I can make it a 10 or 9 dimensional manifold. So if the thing you're interested in is inflation, that's the first one here. So that would be like an axis that you're mainly interested in. So let's make that the y axis, say. And then, but then there's all these other ones. So the original Phillips curve is something like this. This is going to be a bit wobbly because I think I'm caffeinated here.
Can I take one step? Can I take one step back? If I were to ask a trained economist, what do you use the Phillips curve for? Like,
oh yeah, okay, that's a good step backwards. I'm gonna write private sector here. Okay, so they might be interested in the data on the Phillips curve, which they might see as something like this: boom, 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 like that. They might get a few data points.
Okay.
Like this. I don't know. The price level can drop sometimes, and they'll use this to see. Okay, well, if we go to lower, so I should say this is employment, not unemployment. It reverses the graph if you do it as unemployment. Oh, sorry, no, I've got that wrong. What will I do? How will I draw this? I should do. Oh, this might confuse people. I don't know.
Well, you don't have to draw it. How about you just explain to me?
Yeah. I'll explain to you. So this is maybe like the like 1 minus the unemployment rate or something like that. So if you're here, you're at full employment.
Okay.
Let's just say 0. So 0 would be unemployment. So this is like unemployment. I know you can draw it the other way around. So this way, this is just the way the original paper did it, I think.
Okay.
So as you go along here, you're reducing unemployment. So you're getting closer to full employment, but the price level is increasing.
Yep. Okay.
That's what economists do. And then they'll say, this is the inflation that we want. Inflation here just being defined as a continual rise in the price level.
Okay.
Rate of change of the price level here. So this is the inflation that you want. You might call it a desired inflation rate. And so you just go along here and you go, oh, okay, well there is our Nehru. And that's like where inflation is not going to go up faster than this base level of a desired inflation rate. And you might have some models that tell you this then should have a like a slope. This depends on scaling and all sorts, but let me just say roughly that might be like a slope of 1. So for 1 unit of change of unemployment, you get 1 unit of change in the price level, and that's kind of like an equilibrium if you want to think of it in those terms. You don't have to. It's more dynamical. So that's where they get.
So if I ask, Fed researcher, they're going to give me this explanation that you just gave. Yeah. Okay.
Probably something like that.
Okay.
I might be botching it a little bit.
But close enough. Close enough. When employment gets too high, eventually that'll cross. That'll begin to accelerate prices too much. And we don't want that. That would be their answer. Yeah.
We don't want this.
Okay.
But you never see this.
Okay. So it's one of the many models they have that are never actually based on observed data. It is just a model that they made. Yeah. I have models like that too, but I don't use them.
Because somewhere exactly. So somewhere in this regime here is what you would call what you'd call hyperinflation.
Okay.
Something like 20%. I don't know. You can define it however you like.
Yeah.
20% sustained inflation rate, like Turkey or something. Anyway, so hyperinflation is never seen as a function of unemployment, as a function of full employment. So if you get close to full employment, that's never really what drives a hyperinflation, because you get hyperinflation even when you're at quite high unemployment.
Yeah.
So hyperinflation will go off something like
that's a good point. Yeah, that's a good point. Yep.
Well before you get to the Nehru, and that's because it's usually supply shock driven, right? It's not driven by wages. And it's to do with corruption, war, pestilence.
Yeah. The nation's about to end, so the currency's worthless, and they have some reserve-backed currency, and they're just printing it out to get more reserves. Yeah. Just your classic case of a nation falling apart. Yeah.
That's right. So that was not Bill Phillips thinking, right? He wasn't thinking about hyperinflation. He was just thinking about normal wage effect on unemployment.
Okay.
Sorry. Yeah. And so he was focusing on, I guess he would have been using the rate of change of labor. So
Okay.
the time derivative of the thing. Or maybe he was, I think in the curve it would have been 1 minus the change in labor or something like that, right? So that I can draw the curve like this in his original paper. But the economists will just see these blue points and they'll extrapolate and think, oh, okay, well, that means, if we dare go to full employment, it's going to shoot up like this.
Yeah. This is good. Okay. This is
You dare
good.
see it. So, but this never happens. The effects, what changes the price level is not going to full employment. Full employment just makes things, makes output more efficient as long as it's not bullshit jobs.
Yeah.
Like the Soviet Union or something. But it just, so you can, but they'll grab some data and they'll see, oh, there's a point up here. Okay, so it's they'll do that kind of econometrics. But like I said, it's not a curve. So all of these other 4 things here. Sorry, I didn't move that on the screen. All these other factors are going to go into the price level. So the demand for labor, that's kind of labor that we've got, a rate of change, which is what the Phillips curve is.
Yeah.
So this one is the Phillips curve where you do the rate of change of employment, and then you could have retail prices separate. So you don't consider just one price; you consider many prices.
Yep.
Oil, for example, you could probably draw a section of the Phillips manifold that's related to oil prices, and that would be a very strong relationship. Import prices are a big one that Bill Phillips actually explicitly considered. So he only considered a few of these, like he considered this, and maybe 1 or 2 others. I forget, maybe the interest rate. But there are all these others. And the thing is, he said, well, these other ones, they don't have a big effect. And of course, he didn't have computers to do anything.
Okay.
On a calculator, or whatever pneumatic tube system he had.
Yeah.
And so he's just doing a simple analysis and just pointing out that there are some constraints if you don't have a government. But that's the point. So I think he knew Keynes. He wasn't an economist himself. He later became an economist at the London School of Economics. But correct me if I'm wrong, by the way, guys, in the chat. I'm not great on the history. But yeah, I think he would have understood Keynes in that the government can always get you off the Phillips curve. So the Phillips curve really is a pure private sector economy. So it's hard to draw a 9-dimensional space. So what I'll do is just do a very limited Phillips curve thing. So here I'm just going to do 3 dimensions. Gives you the basic idea. And so, this could be like the government deficit or rate of change of government employment, something like that. Or you could have it the interest rate or the import prices. This direction here could be any one of those.
Yeah,
right?
yeah.
And then what you see in a Phillips curve is a section of this that, that looks a bit like this if you're a neoclassical economist. And that's what you're looking at. But if you draw the effect of moving along this axis here, and any of the other 8 dimensions,
then
you'll see a Phillips curve that, maybe does something a bit different like this. So this one might continue being a little bit like a power law out to here, and then it drops down like this. And you might have a curve that goes like this. And I'll try and make it look a bit more 3D-ish here, because there's a point on this curve that I want to try and emphasize here, which kind of goes a bit down like this, and then flattens out like this. So I've drawn that pretty deliberately. Okay, so if you take sections of this curve, like, if you move further down this direction, it'll go like, the curve will change. And if you go up this direction, the curve is going to, let me do that in, say, orange. You go in this direction where the government expenditures here are increasing. On what do you think they're increasing? Anyone take a guess?
Ask the question one more
Job
time.
guarantee.
Oh, yeah.
What is the government expenditure here increasing on? You've got multiple dimensions, right? Well, it
Yep.
could be in government investment, which is, well, let me see. It could be 7. It could be 6. Probably don't even have it here. It's probably an 11th one. So it's just government spending on the job guarantee, and that flattens the Phillips curve. So no matter what the
because the output picks up to offset the
That's right.
Yeah.
So the key thing here, this is the private sector, and that's what you're looking at when you move along this curve, and you go, oh, hyperinflation. But here, what we've got is private sector full employment.
Yeah.
And then this is private sector low employment. And if it's a dot, it could be sometimes the ratio of employed labor to population. Sometimes that is what is given. But I'm using it as the rate of change. So this is just for nerds.
Yeah.
So the labor lambda is the ratio of employed here to the population here. And so my lambda dot is the rate of change of that. But again, you could do both of those axes because it's multidimensional. But the point here is that if you go along some axis and look at private sector full employment to private sector low employment, high unemployment, it doesn't discipline the price level. The price level just stays the same. Why is that? Okay, let me just try and do this real quick on this live stream. Okay, so if the private sector is in low employment here, then if you look at the government sector, which I'll do in, say, green, government sector will be along here. So this will be maximum lambda, the government sector employment. Whereas here you've got minimal private sector employment. So, and they swap around. So if you...
I get what you're saying. Okay.
Yeah.
Okay.
So then later on, you've got,
those will swap, but you're still on that end of the they're on the end of the manifold. Yeah.
Yes.
The
opposite axes.
Yeah.
We can't draw them on the same axis, but like if the private sector then moved to full employment,
yep,
where do you think the government sector would be?
Yeah.
Can it create babies on demand to generate more people?
Not quite. We're getting closer.
No,
not quite. Yeah.
Yeah. So you want to look at employment, and if it's the private sector employing people, full employment in the private sector, then the government sector is going to be low job guarantee employment, or public sector, and so they move in opposite directions, and that is going to stabilize the price level, right, like this. But where have we seen this? Where's the evidence for this? Okay, there's not much evidence for it because no government is doing a buffer, job guarantee buffer.
Yeah,
you could maybe look at the statistics for Argentina when they were running the Jefes program, the job guarantee for them, which was minimal. You could look at rural India because they're doing a rural job guarantee, and have a look at how their price level is changing. It should be pretty flat according to this type of Phillips manifold analysis. So that's the key thing. Never accept Phillips curve thinking. I forgot to do the big, like, teacher gets out her pen and goes,
not
like
a
this,
curve.
Squiggly line. It's not a curve. It's a manifold.
Yeah, that's interesting. Okay.
Minus 10% of your marks. Plus 10%. grade.
Yeah, you know what this looks like to me is this looks like a problem that could be solved by something like a, principal component analysis, like if you wanted a three
Could be,
dimensional
yeah,
model
yeah.
to show it to weigh which of these would
Um,
fit where.
to be sensitive, to be sensitive to this part of the Phillips curve, this region here, it's like you have to, I don't know, an econometrics person might be able to do some sort of very fancy analysis to figure that out.
Yeah,
But to me, you only get a flat Phillips curve, no inflationary impact, if you do it in a Minsky model, because I don't think anywhere in the real world you can find it.
okay.
But I think you're probably right. You could probably see little hints of it coming down towards this direction, but only you'd have to look at government policies
To
look at this. Yeah, to look at this dynamic where the government sector and private sector are on opposite directions of this axis down here in this kind of policy space, rather than up here in this neoliberal space.
yeah.
Is having to look at some very particular countries, and I think Japan might be like one of them, maybe to look at, because they've got. I mean, like I said, culturally, the Japanese don't like unemployment, so they want to be more along this private sector curve here. But if they can't, then they're going to try and do some sector employment to ease the pain, I guess. But I'm not sure that's not really the way they think, right? They're just trying to subsidize the private sector, I think, to do it. So they're using the private sector as the employer, but the government is kind of half running a bit of a buffer for labor, but not exactly.
Yeah.
So I think you could see it. I could see this part of the Phillips manifold in a country like Japan, but I don't think it's easy to see it because no one's got a job guarantee. So we won't really know.
No one's pushing that aspect of to get us to that aspect of the manifold.
And central bankers, as we know, central bankers don't, and treasury departments don't want to look at Steve Keen's Minsky models for this. Although Steve made the mistake of not actually using a job guarantee, he was doing it without that. But if you showed them how a job guarantee can work in principle, you've got a chance at least of getting them interested.
Ty has some comments too. You might want to take a look at.
I'll have a look. At it. It's less about modeling and econometrics and more about political pressure
at this point. Yeah. Although maybe a way to express the whole, in order to get the full dimensionality of it, you'd probably need a Minsky model where each dimension can be plotted. Separately.
You can do that.
Yeah.
But also, in a Minsky model, you have to put in an equation for the price rate of change of price level. So it's still up to the modeler to kind of choose.
Okay.
They could model something. Okay. Something that's a bit fictional. So you do have to have a look. You do have to use the godly tables in that to get the swing between the private sector employment and government, to get that properly swinging. Because you could stick that in by hand. You could just say that this is the government policy. Right?
Yeah.
The government is going to soak up any unemployed labor, and there's just going to be a small frictional component of people who are temporarily out of work, but who are going to get back in because they're in between jobs or whatever. So that has to be put into a Minsky model by hand, so to speak. There's no behavioral equation for it because it just becomes at that point just government policy that they're
a policy decision. Yeah.
So then a treasury official, central bank could say, "Oh, you've just stuck this in by hand." And so what do I say? I say, "Yeah,
that's the point.
Yeah, the government has decided to stick their hand on it.
Can do that, absolutely. Yeah,
that's what the government can do. So you put it. That's on modeling a government policy.
Yeah,
not a free market, not a perfectly private sector market for labor. And you've got to have that because, as Warren said, it's an unfair game, and even neoclassicals accept the game theory. So, labor market's an unfair game. The worker needs to work in order to eat, to survive, whereas the bosses of the firms they have an option to drop employees, and as long as they make sales, they're fine. They don't care.
Yeah.
So it's an unfair game, and the government has to step in at that point as a moral obligation. Forget all the economics. It's a moral responsibility when your tax is causing the unemployment in the first place. But that's a whole other thing. It's like, I think to really utilize the job guarantee and the Phillips manifold as it's supposed to be, and Ty is giving good stuff for the chat on exactly this. I don't know. I think you have to almost recognize that it is the tax liability that drives the demand for the currency, and therefore all the unemployment is by design the imposition of the tax liability, and then the government spends and hires people to get rid of the unemployment that it created. And if you don't recognize that the government really is the source of unemployment in a monetary economy where they are the monopoly issuer of the currency, then I think you're biased or inclined to be thinking that unemployment is a role for the private sector to fix rather than the government. But the government's causing it. The MMT would say it's the government's role to fix the unemployment. The private sector role is to just produce stuff that people want in a kind of quasi-free or fair market, not to employ. The private sector is not, their role is not to employ people. I said this, I think, in our first live stream. The private sector role is to employ as few workers as possible to get the output that everyone wants.
Yeah. I think that's one of the frustrations I have with part of the kind of the political left that really wants to go after the employer to offer the rights that really and the benefits that really the government should be offering. Because I mean, I think the whatever you want to call it, the free market, free enterprise, whatever you want to define that, it's going to work best when it's focused on what it needs to focus on, which is making whatever widget it is that you want. And I think I think the government needs to step in and not force some company to offer benefits or whatever that that they think should be offered, that they can just step in and say, nope, we're going to offer those benefits, whatever that might be. Which that's why and you made this point too in the past. I mean, that's what MMT is. I mean, it's a framework beyond just the accounting recognition of sectoral balances. It really is. It's impossible to step away from some political implications of what that means, because it starts with the imposed tax liability that we all have to pay, that we have to get the currency to pay the tax. Yeah. Awesome.
Worried about the keyboard sounds of putting this in.
Awesome manifold. It would be
yeah. Sorry, it's a bit live. I'll tidy that up for a blog later a bit.
I think we need to do.
It's hard to do because it's better to do it kind of quasi-animated like I just did, because if I just slapped that on as a PNG image, it'll be a bit like what's going on here.
Yeah.
So it's better as a sort of story, I think. Hopefully. Any questions about it? I'm happy to answer. It's just that, I can only draw sort of quasi 3D manifolds here. But the idea is this blue surface that I drew with the light cyan line on it and the orange stuff going on. That surface is very high dimensional. That's the idea. And so you can design policy. If you're a government, if you're an issuer of the currency, you can design policy to move around on that curve any way you like. So like if I wanted to like make it look a bit more three-dimensional, maybe I'd have some shading here and stuff like this. Yeah. There's a little hill there and a valley there, and it flattens out here and so on. But this is a high dimensions, so like a 10-dimensional manifold. And whether you can move around to this policy regime or this one here, or this one here, or this one here, it depends on a whole lot of variables.
Yeah.
Like I said, that some are maybe in government control, some are not. And here's I think this is a minimal set of them. But as Bill Phillips pointed out, you only need a couple of these to get to explain a lot of the data points. You only need a few of these variables. So like import prices, he said, are not that important until the import prices get really out of control, like moving by plus 10% change in import prices. Then you get an increase in the price level, or what we call inflation.
Yep.
That is not related to wages. It's related to the import prices. And he ignored that because at the time for his data in the UK, that it wasn't a big factor because the import prices were not going up too much. But he did identify a point in time where they were, and that could explain some of the movement of the price level. So for instance, if he had a point, say, up here, he would say, oh, well, how do I explain this difference? It's not on my Phillips manifold. And that's because he's moved in one of these other directions.
The other
import prices.
The dimension.
He's gone out and he's squashed the balloon and it's popped out in some other direction.
Yeah.
Import prices, and that raised the inflation rate, or the price level, rate of change of the price level.
Right. Chat, I think we're gonna send. I think I'm gonna ship an Oculus Quest, or now that they're called Meta Quest, out to Bijou, and we're gonna do our next live stream all in VR in the metaverse, so you can draw in full three-dimensional glory.
I'm gonna get into the
and we can have a fun time. They have those the 3D drawing applications in VR. They're a lot of fun. I'm sure you could do some pretty sick stuff.
Maybe, but it makes me seasick.
They've got fixes for that.
Do they? I take some pills.
Yeah. Take some pills. Actually, I'm not kidding. You think? You think I'm kidding? This will be hopefully our viewers don't drop. But I kid you not, sitting right next to my VR headset, which is right here. Hopefully this is on. Yeah, there's my VR headset. Here's my ginger root that I take before I put the VR headset on. And then, it actually works. And then you keep a fan on you. You can have a ton of fun. We're gonna do it. We'll do a VR metaverse so you can paint in three-dimensional glory that it deserves.
Yeah, I think I stuck to 10 dimensions because of string theory. Absolutely, Ken.
What is 10-dimension manifold? We're going string theory.
I don't want to go beyond the limits of physical reality. Calabi-Yau manifold here.
Is that where string theory ends? 10 dimensions? Is that?
Yeah, 10 space and 1 time, or 9. That's supergravity. But if you want to do strings, it's 9 dimensions of space plus 1 time.
That was really cool. I appreciate that. What I can already tell, I mean, again, I get what you're saying now. What this really reminds me of, the Phillips curve kind of reminds me of, is the discussions we have where I think I know what's actually causing some sort of price to move. Take, for example, exchange rates, right? I mean, I have my theory as to what exchange rates are, right? And we'll have the discussion, and then I'll show you this chart that overlays with this other chart, and it looks like there's a correlation there, right? But we really know that there's a lot that's happening that's making that correlation appear. And I mean, we would just call that kind of bro finance stuff, right? Mm-hmm. And I think what it sounds like the Fed or neoclassical economists are doing is just classic bro finance. Like, we have this model. We think it works. We vetted it. And sometimes it tracks. And so since sometimes it tracks and it's the best we've got, we're just going to continue to go along with it. And if it ever falls off, there's chaos or whatever. But we're probably right here. It's kind of what it seems like to me.
That's what I get. I get that feeling too.
Yeah. Instead of, maybe I've got one dimension of this. What else is causing what it is that we're witnessing? Yeah,
Ty, my drawing skills are okay, but like I said, I got the caffeine shakes around here. It's like I did over caffeinate. I have an espresso machine, you see, so I only drink 1 coffee a day, but it's got a lot of espresso. So the wobbly line.
I thought the wobbly line was part of the three-dimensional fabric.
I'm going to always be a bit nervy on these live streams because I always have my coffee before these live streams. So shaky here.
Start sending the questions in if you got them. We can discuss any questions you got. I'm good to keep going too. I know earlier we brought up the topic of the debt ceiling. We kind of kicked things off with that. I know we have something to some stuff to discuss there if we want to keep going. In the meantime, if there are any questions, pop them in chat. Bijou, did you want to kind of change course to the?
What else we got? Yeah, lots of topics.
To the government spending slideshow.
Oh yeah.
Yeah.
I don't know. So this is something that might send you guys to sleep, but I'll have a go. So the issue comes up, and this might come up with activists too, and it's quite a tricky one to deal with. I don't think I had it on my list of things here. Anyway, yeah. Okay, so I'll have to maybe share another
the other screen. Yeah, let me pull up the chat window while you switch.
So what I'm going to do while we're just doing the screen sharing here, figuring it out, I'm going to go through Randy Ray's account of how the government spends, and while I do this, I just want to make it clear that well, at the end we'll get to how Warren would do it, which is what I call an integrated or Lagrangian approach to the economic system, to government spending. Whereas what Randy Ray and most other MMTs, or what the nerds do, is they do like details, like minute by minute government spending, which is what you need to do if you want to explain the United States. And I think it's sort of a little bit similar to New Zealand. We go through this circus, right? So this is the circus. And okay, here we go. Okay, so this is a bit generic, but it's mostly the United States, how they do it. And it's going through Randy Ray's things. You can get this, I think maybe while I'm talking.
Yeah, I'll post the link too, just to set the stage too. Obviously, the debt ceiling thing is going on right now. It's absolutely ridiculous that we're having this discussion again, because the promise of spending has already been made. The decision to spend is set forth by Congress when they set the budget. So that part has been done, right? Yeah. The injustice in this, I mean, it's both one part injustice, one part circus, is that politicians get two cracks at bringing the circus to town. They have the first shot is when they set the budget. The second shot is when they agree to do what they agreed to do. All on the premise that for some reason they believe that the government needs to borrow before it can spend, right? Right. And that is, I mean, that is the fundamental
false belief.
Yeah. And so the steps that Bijou is going to go over explain that. And then from this discussion too, we can also see how, if this process gets stalled out, how it can cause issues, both in the financial economy and the real economy, and then also maybe some ways that we can divert this. But let's first go through proving that it is a false belief to think that the government needs to borrow before it spends.
Right. That's the false belief.
Yep.
The rhetoric is that the government borrows. And the thing is, the politicians who are running this whole system believe the false narrative. But you see, somewhere, someone figured out how to get the government to spend without taxing and without borrowing. Someone figured it out. Or that's one possibility. And they came up with a system. Or the central bankers and Treasury got together and they just figured a way around it. And this is what they came up with. And it's possible to me, it seems plausible to me, that they still don't believe that it's government purely spending, because this is the thing, because they probably think it's the seventh deadly innocent fraud. They probably think, oh yeah, well, the government doesn't tax, doesn't borrow before it spends. But in the future, it will tax in order to cover that spending in the future. So they're saying future taxes will pay for past spending. It's like incredibly nuts. you know, if you've already spent the money, what do you care about future tax return? It makes no sense. You you care about future tax return in order to maybe stabilize the price level or to do whatever the other functions of taxation are, like limit certain things, pull things out of the private sector into the public sector, penalize people for doing things that you are not going to fine them for, or a fine is a tax, kind of. It's just not continuous. It just, whenever someone disobeys the law, they get taxed, which is just called a fine. Anyway, all of that, right? So you got to look up the Warren's 7th of the 7 deadly innocent flaws. I think it's a critical one, absolutely critical. The 7th deadly innocent fraud is that high government deficits today will lead to higher tax return receipts in the future. And the 7th deadly innocent fraud is that this is true. The fraud is that it's a bad thing, because it's not. It's a good thing. If the government deficit is going into helping boost the economy, and it leads to later higher tax return automatically, by the way, without needing to raise taxes, then that's a good thing. It means you've had a growing economy. Tax return that's automatic, that hasn't been just an artificial tax hike. Automatic higher tax return shows you that you've got a growing economy. Anyway, this is how the system with the US works. This is how Congress can spend without taxation and without borrowing. So it first enters into repo agreement, which is just selling some bonds to dealers on the primary dealer market. So there are primary dealers. They awarded the status by government, and they put in a bid for the bonds that the government is selling. So the government starts, though, with a repo agreement, which is repurchase agreement. So the government is going to purchase bonds now, promising to buy them back tomorrow. Okay, so that ensures that the money gets put into the bank reserves for the bond auctions. So the government's giving the money in this first step, and then it's going to take it back, right? So because it takes it back when they that's right. Take it back when they issue the bonds. So next, the central bank conducts a bond auction. In New Zealand, the central bank is the RBNZ. So I just use that instead of the Fed. But you should, because this was for a slideshow for a New Zealand audience. So you should just replace RBNZ with Fed.
With Fed. Yeah.
Fed. So they conduct a bond auction now. They're going to issue some bonds, and the dealers are going to legally obliged to make the bids. Otherwise, they lose their privileges to do that. And in fact, it's funny. It's just so funny because Warren actually says that they often lose money from this. So it's debatable whether it's a privilege or not. But anyway, the central bank accepts the bids, and they debit the bank accounts of the bid of the winner and give them the bonds. And that credits the treasury account, that credits the dealer's treasury account at the Reserve Bank or the Fed. So, okay, that puts money into the government's treasury account because they've quote unquote sold the bond. They just swapped the bond for reserve, but they sold the bond. Okay, so that's the second step. Third step is the Treasury then moves the money into a special repository at the member bank accounts called the tax and loan accounts. Now, I'm not sure if they still have to do this with all the changes to post 2008 crisis, but this was how it worked before 2008 crisis. They would move the money that they just received from the bond auction into tax and loan accounts. Okay, so I just made a note that in New Zealand, I don't think they do this, but in the USA, it's a bit probably obsolete now because of quantitative easing, and they can just use bank reserves for this whole process. But this is how it used to work. And then you reverse the repo agreement. So this is the key thing, right? So the government then puts the money back into the private reserve account because, remember, the repo is a contract. It's a promise to first issue bonds and then buy them back later. So then it's either the next day or an hour later or whatever it is, the government then reverses the repo agreement as per the contract. And then before it spends, the Treasury calls in the tax and loan accounts. Remember, it stuck money into the tax and loan accounts. and it can put it in the Treasury can put that money into its account at the Federal Reserve at your central bank, and that reverses the step 3. So we reversed the repo, and we've also reversed the tax and loan, dance. It's just a dance of money, right? Spreadsheet entries. And then the Treasury instructs the central bank, your Fed, to debit its account and credit the bank account of the agent that it is purchasing from, the government employee, the pensioner, the welfare beneficiary, the government contractor, whoever that is. Just changes the number down in its Fed account and increments, marks up the account of the person that they're paying. And then this particular agent could be civil servant, public sector, private sector contractor, military person, whoever. They've now gained totally interest-free new money. No tax has been involved. No grandchildren held to ransom. On the balance sheets, all of those above 6 steps are equivalent to the central bank or the Fed just simply marking up the Treasury account in return for Treasury bonds and then debiting it to pay the person. And that's I give an example for $1,000. Here's the balance sheets of the Treasury, the bank, and the customer. We don't need to know what the existing state of the economy is with those question marks. It's, whatever the reserves are, it doesn't matter. I'm just focusing here on the numbers that are involved in this particular transaction. So say the government wants to buy bridges. So contract some people to build some bridges. And then so the customer might start off with some bridges, which they have not sold yet, and they're worth 200 units. That could be 200 million or whatever you like. So then you get put in some numbers for the reserves in the bank and the Treasury. So the Treasury has $100 at the central bank, and the customer has, the same thing as before, just the same spreadsheet, but I'm just putting in some fictional numbers for the Treasury and the banks. This is the first step of the process, where there's a repo agreement. So some bonds are issued here on the 4th line down. And then you get the repo agreement started. So that debits the Treasury account here, the 900, increases the reserves, and the bonds go to the primary dealers, which are usually the banks. So the 900 here goes to 900 here, and so on. And there's then there's the auction, so that the government agrees to buy back the bonds. Sorry, to sell the bonds, putting the money into the banking system. So now the banks have got $1,000 here and $1,000 here, so it can now go and buy back the bonds, and in the shift from the bond account to the special repository account of, in this case, I'm just using 100. It's just like the repo agreement's completed there. So now the Treasury has some money in its special deposit account, liability of the bank. And a repo agreement gets completed. Bonds go in the other direction again. And then the Treasury calls upon its special depository. And what am I calling this? Oh, that's the same slide. And then the payment for the bridge is made. Is this? I might have that blacked out. Something missing there. Okay, I just made it over 2 slides. Sorry, this is supposed to be multiple slides. So the payment is made to a customer there.
Yep.
So I just had a separate slide in there for animation purposes, I think. So the customer gets the 100, and the bridge gets moved over to the government. Treasury now owns the bridge.
Yep.
And the net effect is just that the Treasury just got rid of 100, credited the customer with 100. And the bridge came from the customer and moved over to the Treasury. So now the customer is minus a bridge out, but they started with 1 bridge, so their total bridges changes, just -1, if you like.
Yeah.
And so all of those bonds, auction, everything, if you just look at what happened to the monetary aggregates, it's just the Treasury just created this amount on a spreadsheet and moved it over to the customer's account.
But this,
what
yeah,
this
go ahead.
final balance sheet doesn't show is the bonds. So the bonds are still there in the system, and they will earn interest for the dealers who bought the bonds, which would be ultimately, I guess, the Fed might buy the bonds in the end, in which case the government just pays the Fed the interest on the bonds. So it's just the left pocket paying the right pocket.
Yep.
So we could add the qualifier that if the interest rate on the bonds is 0, then the bonds just become equivalent to cash of 3 or 6 month maturity. So it's not quite like 0 maturity cash, but it's close enough to cash because it's not earning any interest. And so in that case, I collapse the bond accounts from the previous slide. I can just collapse this row into just the cash row here. Then the $1,000 of repos that were bought and sold and swapped around, they just net to 0, and the net effect is just the government actually just deficit spend. No tax, no actual borrowing, even though there was this in between smoke and mirrors game.
It's elaborate,
smoke
and mirrors.
Bond issuing and then buying them back again.
Yeah.
And then shifting the money around these accounts, which I think today is no longer done, but it used to be done like that.
Yeah, I'm actually
that's Randy's 6-step process, and you can have a look at it in his lectures.
It's interesting because I'm going over all the daily treasury statements, and I've quite literally printed them out to notice the difference between the different operating cash balance accounts. And in the 2005 one, the tax and loan account is there, and it has billions of dollars in it. The 2014 one that I have does have it removed. They do have a short-term, they have a short-term cash. Yeah, so by 2014 it gets removed. So they did.
It's removed.
And I think in the actual, because I think it also is in table 6 or 7. They don't have them there anymore. And I think that's where it used to reside. Table 5.
Mm-hmm.
So they got rid of it. The bigger point here is every step you went over between one in the last step are all there because of self-imposed constraints.
Yeah. Because the Fed is not allowed to just go and mark up anyone's bank account. And the Treasury is not allowed to just drop the minted coin. The Treasury is not allowed to just mark up its account at the Fed. So it's just a rule. It's a rule that could be removed. That I think the fear is that if Treasury or via Congress realize there's no rule, then they'll just keep spending no matter what. They'll just spend wildly out of control.
Yeah.
That's the moral panic that the economists want to put into people. So they deliberately misleading Congress.
Yep.
It's not the Congress. It's not necessarily politicians' fault that they. They should be learning the stuff, right?
Yep.
If you're going to go into Congress, you should probably understand this. But it's not.
It's asking a lot for America. Okay.
Yeah. Who's going to teach you this? Bernanke or Summers or Krugman. They're going to teach you wrong. So, and they're probably almost deliberately teaching you wrong because they fear the moral panic if you suddenly realize you are the currency issuer or your institution is anyway.
Yeah.
And so you can just vote to bring any resources into employment that you want to bring into employment.
Yeah.
It doesn't have to be just the military industrial complex. It could be anyone who's available to work. You could bring them into employment if you understand this.
Yep.
So I think they're deliberately keeping Congress in the dark about it. But the thing is interesting. Douglas reminded me of an interview Warren Moser did with these 2 libertarian teenagers. And I asked him, because they actually read Randy Wray's book, Modern Monetary Theory Primer. And they read about these 6 or 7 steps that I've just gone through. And they were asking Warren, is this really how it happens? And Warren's going, well, no, just the Fed just marks up a bank account. So he just goes straight from step 0 to step 6. He's saying because he's interested in the net effect. What's the state of the system at time 0, and what's the state of the system at time t equals 1, and just skip all the in-between steps because they're irrelevant.
Yep.
It's just a dance of numbers on spreadsheets, which is just to satisfy the rules, the playground rules, and these really are just like a playground rules that make it that the Treasury can't just increment markup bank accounts by itself.
It's kind of like when I try and code something and you try and code the exact same thing, and I've got multiple steps that are just repeating themselves and then undoing what I did, and you send me the exact same code that is just 2 lines, and I'm like, oh damn.
Right.
The only difference is I'm smart enough to realize they're both the exact same thing, and I'm just going to learn it, and I'll copy your work next time. But the Fed, for whatever reason, in the Treasury. Well, we know the reason. Unfortunately, it's political. But it is. I mean, it would be akin to me saying, no. You've got to do it the way that I did it, because I looked it up on Stack Exchange, and this is exactly what they. This is exactly what they told me.
You've got to add 2 pi, and then you got to subtract 2 pi.
Yeah.
So if you don't do that, you're disobeying the rules, buddy.
Yeah. It's really what it feels like. As you were going through that.
Any mathematician understands this. Sometimes you have to add x and subtract x at the same time. I don't have an example to hand because I'm only just doing this live stream. But if I had a good example, I could probably pull up one. So if you want to factorize polynomial equations and so forth, then there's a lot of algebra where you actually want to add 0 to your equation, like an in-between step to simplify it. So the way you add 0 is you add x and subtract x at the same time, but then you kind of separate them and do some things with them to get the equation into a form you want.
Yeah.
But high schoolers understand this all the time as you multiply the equation by 1. Multiply by 1, and that's such a common thing in algebra, right? But how you multiply by 1 is what makes a difference. You multiply 1 by multiplying by a and dividing by a at the same time. Or multiply by pi and divide by pi at the same time. So you haven't changed the equation at all. You just multiplied it by 1. But you do that in order to then separate things out and rearrange them into a form that you like. And so that's kind of what this game between the Treasury and the Fed is doing. It's like, it's rearranging things so that it looks like that the government is having to borrow. Yeah, we're not just creating money on a keyboard, but the net effect, as Warren explained to these libertarian teenagers, the net effect is the government really is just typing a number into a bank account, marking it up, and that's what it is.
So to draw this back to kind of the here and now and what we're dealing with the debt ceiling issue.
Debt ceiling.
The step that Congress can stop is the ability for the Treasury to issue new bonds above where that debt ceiling is. I don't know what correct. Am I saying that correctly?
Say it again.
I
was reading the chat. Sorry.
Yeah. Actually, I do have a question. Ty, if you can type this in, the Consolidated Revenue Fund, is that what the new Is that what the new tax and loan account is? My question was, my question is, where in the steps, where in your steps is it that the Congress can impose? I'm sorry, Congress can allow the debt ceiling to be hiked.
Yeah.
And the debt ceiling stops the Treasury from issuing bonds beyond what would be the accumulation of that value of bonds beyond where the debt ceiling is.
Yeah, it stops it. So the problem is the bonds have a maturity, so they don't retire immediately.
Yeah. Yep.
So if they're not retiring fast enough, then you hit a debt ceiling because you've got a growing population. You needed growing money supply, and so you're going to hit that ceiling because there's going to be too many bonds out there that haven't yet matured.
Yep.
And some nerds are keeping, some libertarians and Republicans are keeping a score of that and publishing it, all the time.
It is actually, it is really, really wild when you track the daily treasury statement to see how many bonds are issued and how many bonds
Yeah.
are redeemed. I mean,
Hmm.
it's into the tens of trillions, hundreds of trillions, I think,
Yeah.
throughout a fiscal year. It's a
Yeah.
pretty wild amount that's swapping hands in any
Right.
given. Yeah, I'm
Yeah, I
just looking
think
at the.
Josh is right. So you got Josh, Ty, and Ken there weighing in, and I think, yeah, I think we'd agree with you all there. This whole dance of numbers is really just a farce, and yeah, it's just done to satisfy the to make sure that even the public gets miseducated about it, so they think that there are these constraints and that the government is being quote unquote responsible because it's borrowing, it's responsible to repay, blah blah blah.
Yeah, yeah. I
But
think
if you
what's.
like,
Go
why
ahead.
in Canada haven't they actually gotten on realized that because you can have these overdrafts that you can skip the whole auctioning process like Josh is? Yeah, I don't know why they don't understand that system. I'm not sure about the Canadian system because I've actually I encountered a positive money person from Canada, and they were just insane. They thought that the government definitely was borrowing from the central bank, but I thought Canadians would be a bit more sensible and they'd understand that their central bank is part of government. So you know,
Oh yeah,
perhaps
yeah,
Ty
yeah,
can
yeah. We're in
eliminate
the
us on this.
we're in the
Yeah,
U.S. It's There's this idea that it's
yeah,
really
Ken,
a
thanks. Yeah,
banking cabal. Yeah, go ahead. Yeah.
yeah. Yeah, I'll update my slides. If I said the Treasury is conducting auction, it's because in New Zealand I don't make a distinction between the RBNZ, Reserve Bank of New Zealand, and our government and Treasury. They're all just part of the. They just occupy different buildings. That's all. But yeah. Oh, Jeff Eater, probably. Although maybe not. There was a guy on you. It was a guy that made a YouTube video on it. I don't understand his name because he had an alias, but he could have well been Jeff Eater, who the guy who phoned in to Warren on that chat one time and was adamant that it was government borrowing from the Fed. Yeah.
One thing that I do want to point out, and how this can tie back to markets, is banks are reliant on a certain mix, a ratio of reserves, bonds, various assets that have different tiers to them, and they have to. It's a delicate balance to ensure that they're properly capitalized, that they have regulatory constraints
Right.
through the wazoo,
Yes.
right?
Yes. Yes.
And if the bonds dry up, right, then that means
Right.
the ratios that they have to hit for the balance sheet,
That's
that the
right.
composition of their balance sheets will
Yep.
change, and they
Yeah.
will be
Yeah.
forced to sell assets, and they're going
Yeah.
to
Yeah.
sell assets that are most closely connected to assets that you don't want them to be selling, right? I mean,
Right.
right.
Yeah. Yeah.
And of course, the difficulty is for the real economy is that unfortunately, I guess I should say, the real economy is so interconnected with the financial economy that the knock-on effect there can really spiral.
That's right. So that's why Warren and I think Randy as well say that the 3-month Treasury issues are just needed to avoid that whole
Yep.
issue.
Yeah.
So you still keep the bonds in MMT, but you see the idea is you want to make the minimal policy changes as possible because otherwise it really does get disruptive. So that's why, unfortunately, I'll talk about having a job guarantee, which is starting wage of everyone gets $100,000 an hour, and then you understand that instantly the price level is going to just upwards by a few zeros on the end of everything, and everyone who's hoarded millions of dollars is now basically at par with everyone else. But that's just an extreme, that's a thought experiment.
Yeah.
thought experiment.
Yeah.
It just shows you what you could do if you were like some sort of dictator with the MMT system. So what instead you do is you make the job guarantee wage above the current minimum wage, and then you can sort of gradually increase it as you need to. So the same with the treasury bond auctions. So if you don't want to have a massive battle in changing all the credit requirements for the banks and their Basel Accords and all that,
yep,
then you just leave them as they are and give them 3-month treasury bonds so they can satisfy their reserve requirements and so forth, or the collateral requirements.
Yep.
Is that what you're saying?
Yeah. And my point too is this is exactly why the debt ceiling being stalled out, or the raising the debt ceiling being stalled out, can directly affect financial markets. It's because they are, for better or worse,
tied to the real economy.
Tied to the balance sheets, which are tied to the real economy. And then as we started this whole live stream out with the brief kind of market update, which is the banks are aware of this, and the banks are also closest to the largest kind of investment institutions, and they've got a pulse on the real risk that the government may or may not actually go forward with this. The Republicans would go forward with this, and if they think it's a big enough reality, they're going to start opening the hedges, and then that just starts the entire. I mean, I think we saw this in 2012 or whenever the big sell-off happened around the debt ceiling. I mean, it's exactly how it played out. Is there was enough perceived risk that it it hit markets without it ever actually happening. I'm reading the chat now and I'm laughing. They're normal Canadians. That was really good. Really good discussion. So hopefully a couple things. One, I did post the link to Randall Ray's discussion that is on this. Yeah, I posted that a while up. Yeah. So if you're catching this, not in the live stream, but you're catching this after the fact, scroll on up. I think the chat replay is still on. It's in there. And then if you do watch that video, his discussion starts right at about the 40 to 50 minute mark, specifically with this part of it. And then there's also Ray's slide deck linked in the description of that video. And that video is part of a larger 10 video series as well. So if really all it is that you're looking for is what Randy Ray has to say about that, and go over Randy Ray's thoughts, you can jump to I think it's about the 40 or 50 minute mark. So
it's pretty good. So if you want to get into the weeds with anyone about how the government spends, and that's good to go to.
Yep.
But it does require some effort. Like, I'm pretty sure most people who haven't seen that before weren't really following what I was saying, which is why I was a little bit hesitant to go through it, because if I was going to draw that out and just explain every transaction there, it might take a while. But it's an issue, right, for activists who are just talking to people and neighbors and friends and family.
Yep.
You might want to even just avoid that. You might want to just sort of say, there's this process that they go through, but the net effect is that the government just gets a computer, marks up your bank account, and there's a bond that's created, maybe or maybe not. But if it's created, the government might issue that, and it's paying interest. That could always be paid as interest to the central bank, which is just the left pocket of government paying the right pocket of government as a kind of a game that is played to, quote unquote, discipline the politicians, because the politicians, they're spendthrifts. They just want to spend.
Yeah.
We can't help them from spending. Someone's got to stop them. It's got to be the superhero central bankers with their. This is the fairy story that the economists want to tell us.
It's almost like we vote our politicians in to enact the policy that we want.
It's almost like that.
Yeah.
So
yeah. And what we really need is bankers to stop us from enacting the policy that we voted in.
Yeah.
That
Got to
is
have someone constraining our
constraining.
output
Yeah,
and
constraining.
development.
Yeah, exactly.
If someone doesn't hit us over the head enough,
Yeah,
we're just going to be too comfortable.
yeah. That was great discussion. I've got chat back up. Anyone has any questions, go ahead and put them in chat. I think we're kind of getting towards the majority of what we had planned for tonight.
I had a lot of follow-ups, but
okay, yeah. Let me switch to.
I don't know if there's a good.
We can definitely switch.
One thing that Steve Grumbine came up with, he was doing a live stream too, is using the sports analogy. So that one is like, how come all these right wingers and that they love their football and their baseball and hockey and whatever you've got there, whatever national sports things, but you've got salary caps. They figured out that there has to be some sort of salary cap, and there have to be some rules to make competition fair. It's not just gladiatorial combat. So right there, you've got in professional sports, you've got a system that is pretty highly regulated, I would say. His point was, how come that's not, how come that's not good enough for the economic system as well? Have some rules, people stick to the rules, have some salary caps so that people don't, so that the rich don't get richer, so you don't get like the New York Yankees just grabbing all of the top players, and so they win all of the time. Because otherwise sports becomes boring, right? So
if I'm not mistaken, though, the main European soccer football leagues don't have salary caps. I don't know if we have any Europeans.
Yeah, you're probably right about that.
Because I think
Europeans,
because I think the same 5 teams win every year.
That explains it. Yeah. To me, that's a bit boring, but
yeah.
Anyway,
they love it. They love it.
Yeah, because they like their winners and that.
Yeah. Yeah.
So I'm just going to scroll through some
of go for it. Yeah.
I got here. I don't know how long you want to go on this live stream, but
if there's anything else you want to if there's anything else you want to bring up,
I don't know.
We can bring it up. Otherwise, I'm not seeing any other questions. So we are in the 3rd hour. So this is when.
Oh, okay. Yeah, we could start talking off topic. I just mentioned that there's a lot of little issues that can turn into slightly big issues as far as inflation goes. So the one that I mentioned to you, remember, was the egg prices, and it was interesting because someone else didn't you mention the egg prices were going up a bit or something?
Yeah. They've
So they did this in New Zealand too, but they did it in a funny way. So I think we've got a Green and Labour government in New Zealand, and so they're doing some of the things that they've always wanted to do for a while. We had a long period of right-wing neoliberal government, but they're not right-wing really bad. They're just neoliberal and bit conservative. But
explain to me what right-wing really bad actually looks like.
Oh,
I'm joking. I'm not going to. I won't do really. You're good. Keep going.
I don't need to explain it, right? You need to explain it to me.
Yeah.
So they wanted to help the chickens out, and so there were going to be these regulations in New Zealand that required sort of more free range farming, and it was going to be a fine, or maybe illegal, at least a fine to have chickens, hens growing, laying their eggs in too cramped conditions. So they're going to free the hens, and of course all the farmers then were like, shoot, regulate. They now suddenly have a lot of cost increases, and maybe they're going to convert their farms now to doing something else other than looking after their hens and chickens, and so the price of eggs goes right up. And we had a bit of some supermarkets had run out of eggs a while back. So that's a way that when MMTers say that the government is the monopoly price setter, they're a price setter in many ways. So you can just have a little change to farming regulations,
Yeah,
and
yeah,
suddenly
yeah.
see
Yep.
not just a price rise, but because it's hard to change prices of things like that. But you'll just see a supply drop, and
Yeah, yeah.
you can expect a lot of that sort of stuff to happen once things sort of get back to quote unquote normal.
Yep.
And then you get people who into government who want to do well, and they don't sort of think things through. So there's always a way of making the chickens happy, but not making the farmers unhappy.
Yeah, yeah.
That's what I would say.
Yeah. The joke is there, man. I got to just say it. It sounds like your government counted their chickens before the eggs hatched. Yeah, there it is.
Absolutely.
But let's see. I'm not seeing any questions coming through. We did get a confirmation that the European leagues don't have salary caps, but they have a bandwidth they're allowed to spend based on the revenue.
Yeah.
Revenue. Oh, no kidding.
Okay,
that's interesting.
Yeah.
That's interesting. Okay.
Oh, it does cater to big teams. Yeah.
Yeah. Obviously,
if it's too democratic, you don't have enough of a lobster hierarchy.
Yeah.
So you don't have too democratic, then it's like a coin toss whether a team is going to win or lose any day. So you to make it interesting, I think in sports you do need a few kind of big player champion teams. So you've got little underdogs that sometimes suddenly have a massive win, and it's like it's so great for them. It keeps the supporters going, and that sort of whole dynamic of sports.
I was thinking about this. My son, after the World Cup, started getting into European football, so I'm starting to learn a little bit more. And I didn't realize that there is no. I mean, there are only 5, 6, 7, 8 teams that ever have a chance to win a championship any given year, and they're the same team. And so, I mean, you'll have fans of clubs that never have a chance. Which in America, I mean, I'm a Lions fan, so I do understand this reality. I mean, they've never come close, but
some people just like being underdogs.
Yeah, and that's it. Yeah. That I mean, your city club will always be an underdog by definition. But it's kind of cool. But then that one city, like 5-6 years ago, is it Leicester won? I think the Premier League. I mean, they had like a salary. Of all their players, it was like a tenth of the the biggest teams. Anyway, Detroit Lions. Yeah, I'm a Lions fan. Yes, Ty. The Detroit Lions. I grew up. I still live in Michigan. Grew up in Michigan. So, anyway.
Yeah, Ken PDX. Every now and again, I don't mind exposing myself to libertarian views just to knock them down. It's a bit hard though. At the moment, what I was doing was following Perry Merling's lectures. I think I mentioned them before. Douglas recommended them, but I'm finding it hard going because there's so much gold. Gold is the ultimate money, according to this sort of view. So it's like, whoa! I had to do some comments on his YouTube channel there. I think I'm the only person making comments.
Ever made a comment on the videos. Yeah.
Maybe there's a chance you'll read them. I don't know.
I think if you're going to listen to the Perry Merling videos, I think you need a good foundation in MMT in the sense that and I would only watch them to get a better understanding of the mechanics that happen in the Eurodollar system in global financing.
I'm hoping to get there.
Yeah. It eventually does get there. It eventually makes a lot of sense.
Good. Yeah, I'm looking forward to that, but I have to ignore the gold part, ultimate money part.
Yeah,
it's so cringe, man.
when he originally
I'm almost just become hilarious.
When he starts out of the gate and he talks about what real money is and all that sort of stuff and how we don't really know, that part is goofy, but he does explain
that the Eurodollar and all that.
The Eurodollar system quite well and how it all functions and problems with it. Yeah.
So I look forward to that.
Yeah.
But Douglas gives me a lot of homework. I got TensorFlow and other things. Dynamical systems. Geez. So it's still going to be a bit slow on that front. But I will, if I do hear a good thing from Merlin or a bad thing, I'll put it in my blog maybe. So the question
Ron
here.
Paul got me not into economics, but I was a big Ron Paul guy for a few years as well.
Yeah.
Yeah,
You
sorry.
guys started
Shame.
off Ron
Shame.
Paul. Yeah, I could never have started off with Ron Paul.
Oh man, I for sure thought he was going to be
I did. My
president
family
in
just came from
2008 or
working
whatever.
class labor background.
Yeah. Yeah. Ken, yes, he does offer some good insight. Snyder does, and he's one of the very few guys that listen. In order to get into that world that he's in the circuits of all the different talk shows and the finance circuits, you need to appease them, and so Snyder will. But I think he has, and I think he truly is kind of a right wing economics type guy deep down at heart. But he at least understands kind of the way that Perry Merlin does that the finance world is just layers of balance sheet operations that occurs. Now he'll talk about the government or banks just create money out of thin air. As though it's some pejorative, as though it hasn't always been that way, right?
Yeah.
But
it's supposed to be gold.
Yeah, exactly. But he still has a pretty good grasp. And then also too, I mean, if you're trying to collect data, he's really helpful because he'll get you in the right direction to understand like how to get the tick data, how to get the tick data pulled up, how to understand various ways to measure what's happening over in the Eurodollar market. I mean, they call it the shadow banking system because so much of it occurs, behind what's being published. So he is helpful to that extent, but depending on how sensitive you are to, depending on how sensitive you are.
What is his take on the whole shadow banking thing?
Yeah, I mean, he would just again pejoratively say I think his overarching take is that the system just broke in 2008, and to a certain extent, I think that's true. I mean, there was a realization that the bank next to you really is reserve constraint in the right in the global financial system. There are real dollars, and then there are these dollar denominated loans that get treated as dollars that are completely separate, right? And for the most part, there's this unwritten agreement that the Fed will just bail out everything. So you have that aspect of it. But when push really comes to shove, or when chaos emerges, we saw this in 2008. It's very aware that these Eurodollars are not dollars, and that what really are dollars, the dollars can trace themselves back to the Treasury, right? Through the balance sheet operations. So I think he would say that entire Eurodollar system broke in 2008. And my guess is what he is sensing is the fact that kind of the private debt cycle also broke at that time. And so there's just an inability, one part of it might be because of just austerity. One part of it might be because of new bank regulations. But there's an inability for this global system to take back off again, this global Eurodollar system to take back off again. And we see it too. I mean, every time the dollar pushes higher, it wreaks absolute havoc on the Eurodollar system. I mean, Europe and the rest of the world gets destroyed when the dollar rises, and I think it's just because the dollar really now is it's turned into a gauge of what the Eurodollar credit market is. When the dollar pushes down, I mean that's how I come to this conclusion that we've talked about.
Yeah,
when the dollar goes down, it's the Eurodollar market expanding, new loans are being created. You see growth out of that. When the dollar pushes higher, it's because that growth cycle has stalled, and it's reversing course. So that's kind of the take on it.
Yeah, I think that actually plays in a little bit to Josh's question on the. He says, if the debt ceiling debate does play out long, what kinds of worldwide implications do you see from it?
Yeah, I mean,
I think you talked about this earlier, but maybe he wasn't there for
that. Worldwide, yeah, it would also. It would also cause issues, in part because not only are real dollars necessary, obviously to pay the interest on Eurodollar loans, but the entire Eurodollar system is set up with the highest collateral on the balance sheet as bills, treasuries, bonds, is that what they call pristine collateral. So if those aren't being issued, those will slowly but surely dry up over time, and that will absolutely crunch the global system that is built on this. So yeah, it'll hit the global system as well, and have detrimental effects. And I would imagine it would be, I mean, you could probably build some model to see how quick it could happen, but I would imagine it would be pretty darn quick if it's the juice that keeps the system going.
But what you're assuming there is a certain type of playing out of the thing. But what's not clear to me is how it actually is going to play out. I mean, because what you got is recent history to go by, and they always seem to sort of find a way to get through the debt ceiling problem. Like I said, they could just do what Bill Mitchell and Warren and Randy say, and just to issue 3-month treasury notes.
Yeah,
and that's it.
yeah, yep, yep.
Just play the reverse repo game and be done with it, and then it's so all they had to do to get around that type of problem is to just say, well, we're not going to count a 1 month increment to the debt as long-term government debt. So as long as they define the debt ceiling as like an annual thing that increments, they can always make that increment to zero.
Yeah.
Because they're just using 3-month bills to just roll over, and I think you could do it that way anyway. I guess the question is, how are they going to do it? Because they're going to have to do some workaround, and so that's what I'm thinking about it playing out. And yeah, it's hard to say.
We'll find. I mean, we're probably going to find out. That would be my guess. Is we're going to find out how close we can get to the edge, and see what happens. So
things seem to be ripe to be this time around. It probably is a good indication of the actual edge that you can push all of this to.
Yeah,
maybe.
Yeah.
I'm just speculating here, because everything's sort of in alignment now to really, if you're going to ever have the debt ceiling be a real thing, this is it.
Yep.
Because any Dick Cheney or Trump or whoever who wants to come in and spend is going to just ignore it totally.
Yeah.
Monique is asking about the New Zealand Prime Minister.
Yeah, I just looked that up on my phone. Yeah, stepping down.
I think good on her. It's not like we would suffer. The small business community really hates the current government because of the effect of the lockdowns and the high interest rates and all that. So they could have done a better job of things, but they were never going to, because they're still infested with neoliberalism, the neoliberal brainworms. But I tend to think that she's fairly honest and transparent. This is Jacinda Ardern, New Zealand Prime Minister. And I think I would trust her on her statement that she's looked ahead. She wanted to get recharged, get some energy back. And, she's a mother, and it's been very stressful for her, and COVID is over. We kind of survived COVID in a way. We ran the America's Cup, one of the most premier yachting events in the world, in the middle of COVID. They did enough she's done enough to feel like she did an okay job and retire on a high, relatively speaking. This is still, like, people are going to say she's retiring because she's chickening out and hasn't really seen through the inflationary period, but she will do, because the election's not until later on. So still got so I think a fair legacy for she's supposedly left wing. She admires the social democratic governments and other world leaders. So as far as having a neoliberal bias, just through being alive at this time, just being X generation or millennial, I think she's done as good as she could have, and I don't think any reason to not believe her that she's retiring, because it's exhausting, and you get attacks from the press all the time, and activists like people like me who are more activist than me, complaining that the low wage and the unemployed are getting a really rough deal still, pushing her, squeezing her at one end, and the financial press and the ultra neoliberals squeezing at the other end with the inflation hysteria. It must be pretty exhausting, I imagine. And I think it's probably a good time to retire just for personal reasons. Yeah. But the implication is different, because I don't think we're going to get anyone any better. So I don't think, a lot of the policy is going to move too much in good direction. It's just going to be the same as usual, probably. And they might even do some crazy austerity stuff. They're already talking about raising local government rates to pay for things, rather than using central government grants to fund the local councils. So, like, for instance, I'm just going to have to pay more rent now for no reason at all. Just because the government's not grant funding the local councils sufficiently. There's a lot of work that needs to be done, and a lot of labor that can do the work. But if you're a need the taxes to fund it person, then it's just going to squeeze the middle class. So, good personal decision for Jacinda Ardern, but it's not going to help New Zealanders much if she retires.
A lot of Canada people showing up tonight. Welcome, Canada. Yeah, it's pretty wild. I saw it pop up on Twitter, or at least the headline, but I didn't fully, I guess, comprehend what was going on. Yeah. Well, best of luck, Bijou, with whatever election come up next. It seems like the global politician pool has been pretty sour for quite some time.
Yeah, it's quite a system that filters people.
Yeah, that's true too.
Keeps good people out of government, and
yeah, absolutely.
Sometimes the odd good person gets through, and
and
when they do, that's sometimes good. But it's a whole system that we're fighting against. So I don't see it. Oh yeah, so this is one last thing that I can go out on, maybe next week, because we're probably dropping viewers at the moment. But just remind me for next week. So it's about education, really longer term. That's our main weapon, is education and understanding. It's far more powerful than any guns or any sort of violent marching and protests, although they have a place when things get really bad, but for general progressive education and emancipation of the working class and decommodifying labor, or whatever you want to do, it's got to be education ultimately. Otherwise, things fall back to austerity. If you have even a highly left-wing government, they don't understand. They're just going to be using austerity. They're just going to complain, "Oh, we've run out of money." So, on that note, here's another thing that I got from Bill Mitchell: is he's working on some children's books, MMT children's books.
Well, that's fun.
And our whole thing is part of his MMT Ed. So he does a free university course, or you can pay to get a certificate if you want to.
Yeah.
But he's also going to get a Japanese manga illustrator.
That's funny.
Cartoon thing.
That's cool.
Which will go together with Steve Keen's stuff as well, debunking the neoclassicals, the cartoon version of that.
My son's been reading a lot of the manga stuff, and he's in this getting into this popular Berserk series. I don't know. I got it for him for Christmas. I flipped through a few pages and realized that maybe I'd made a mistake, but he's enjoying it. So maybe I can get him some economic books that can.
Right. Berserk is pretty wild.
Yeah. Okay, you've heard of this then. Okay. Yeah.
Yeah, Berserk. Yeah.
It's
kind of like Japanese sort of Nietzsche stuff.
Yeah. He loves it,
Dude
man.
with massive sword comes in and like acts
Yeah.
as a hero, but he's an anti-hero.
Yeah. Yeah, I flipped through the pages, realized I probably made a mistake, but you know, kids got to learn. Kids got to learn sometime. So, yeah,
Yeah, give him Steve Keen's cartoon book on economics.
yeah. Maybe I'm a terrible father for letting my 14-year-old get that.
There's a good graphics novel about Richard Feynman. I'd recommend that as well.
Okay. We'll pick it up. We'll pick it up as part of his education. His
sneak it in, like cartoons.
Yeah. Is I
I'm
make
waiting
him
for the MMT game,
Oh yeah.
complete with zombies and guns and neoliberal zombies and all that.
Oh yeah. Oh man, don't derail me. No, I've been so focused on finishing our deep learning models. Do not derail me to make the MMT game. I need to look up. Can you look up this? Here's the derail. Exactly. Ooh. Yeah, what kind of?
We've got to go though, guys. I can't derail this entirely because I know that Douglas is pretty tired and had a long day.
But you said
the fun stuff is always a bit energizing, right?
But you said there's a Feynman graphic novel. I did. Look at that.
Yeah.
Oh my god.
Yeah.
Let me. Can I share? I'm always scared to.
Probably not even as good as Feynman's books. Surely you're joking, Mr. Feynman, which maybe Ken has read.
Okay.
Is quite funny. It's got great little anecdotes.
There is a Feynman graphic novel. That's really cool. Okay.
Yeah. I think Surely You're Joking, Mr. Feynman, and the one on the Space Shuttle Challenger investigation is pretty good too. What do you care what other people think? That's a good one.
All right. Well, we've hit
much economics in it, so it's a bit off the topic here, but happy to derail. As
we're figuring out, economics is really just social physics. So
yeah. I think people realize that the Large Hadron Collider was probably pretty good for the European economy.
Yeah.
All those physicists, I'm telling you, all those engineers and physicists, they don't get to save a hell of a lot of their income. They're spending most of it. So.
That was almost in Texas, man. I mean, that was.
Yeah, that was a wild one, though. Jeez. All the corruption there.
Yeah. All right.
I came across a few physicists who were going to be employed on the superconducting super collider in Texas, and it was pretty devastating for them to have to try and find a academic post after that.
Move on. Yeah, I could imagine.
Where do the hadrons come from? The banks create the hadrons on a balance sheet and send it to the LHC to collide.
I like your comment earlier too, Ken, about they make it out of thick air as opposed to thin air. That's pretty good.
Yeah.
That's pretty good. All right, I'm not seeing any other questions, and this train is fully derailed at this point. As always, it's been a blast. We will hopefully be back next week, same time, same place. Batman.
Oh yeah. We need an outro, so you probably do your own. What do we do? Like, does anyone know Randall Ray? It's like high-powered money. Holy high-powered money, Douglas. But to tune in next week and find out if Randall Ray can rescue Tom Paley from soiling his brain with worms.
Jeez,
with neoliberal brain worms. What Ray is going to do is he's going to turn his pocket pixie dust into an IOU that Tom Paley can accept. Will he do this or will he not? Or will Tom Paley impale himself on the endogenous money butthole of bank credit? Find out next week, same MMT time, same MMT channel.
I had a Patreon plug lined up, but I don't think I need to. It is in the link in the description below. On that note, it's been a great night, everybody. We'll see you next week, and we'll talk to you then.
See you next week.
See ya.
Bye, friends.